I don't think you want to be taking a whole lot of risk ahead of this election.
Fiscal policies of this country are making monetary policy for our monetary policymakers much more challenging.
Biden has played his cards in a sense, and I think Trump is talking a whole nother level of protectionism.
Biden's policies on the fiscal side are much more in line with kind of controlling the deficit.
We have policies that have been in place for 4 years. That continues. I think the markets basically can get some comfort out of that. Any big shift, though, look out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg, and we begin with our top story, a disastrous performance from the president in Atlanta, Georgia.
We had the greatest economy in the history of our country. We have never done so well.
The economy collapsed. There were no jobs. Unemployment rate rose to 15%. It was terrible.
They spent money like a bunch of people that didn't know what they were doing, and they don't know what they were doing.
It's simply not true. There's no data to support what he said. Once again, he's exaggerating. He's lying.
The only jobs he created are for illegal immigrants and bounce-back jobs, a bounce back from the COVID.
Until we get the total ban on the total initiative relative to what we're going to do with more Border Patrol and more asylum officers.
I really don't know what he said at the end of that sentence. I don't think he knows what he said either.
How many billions of dollars do you owe in civil penalties for molesting a woman in public, for doing a whole range of things, of having sex with a porn star on the night while your wife was pregnant?
I didn't have sex with a porn star. I'd love to ask him, and will, why he allowed millions of people to come in here from prisons, jails, and mental institutions to come into our country and destroy our country.
The only person on this stage is a convicted felon is the man I'm looking at right now.
When he talks about a convicted felon, his son is a convicted felon.
You're the sucker. You're the loser.
Killing Roe v. Wade and moving it back to the states. This is something that everybody wanted.
Dealing with everything we have to do with, look, if we finally beat Medicare.
This was supposed to address concerns. It exacerbated them. Instead of putting to bed questions about the president's age, if anything, he made the former president look 78 years young. There are some big questions this morning across this country.
And really highlighted, if you want to go to the election betting site, if you take a look at PredictIt, they currently are pricing in a 62% chance that Joe Biden will be the Democratic nominee, down from 86% the day before. Real questions setting in about whether he will, in fact, be at the top of the ticket.
It was the one bar he had to clear. He had to put to bed these questions, the nervousness within the American electorate that we see time and time again in polls, that he was up at 81 years old. He was up for another 4 years, up to the job, and he did not do that. Within the Democratic Party, David Plouffe, former President Obama's campaign manager, on MSNBC last night, calling it DEFCON 1. Kate Bedingfield, Biden's former communications director, saying her former boss's performance was, quote, disappointing, saying his biggest issue, that he had the energy, that he had the stamina. He wasn't able to prove that last night.
A CNN flash poll, I think, speaks for itself. The results of that flash poll, Trump winning by 67 to 33%. That margin's absolutely huge. When you go through the details of that debate, just go through the timeline. Around 12 minutes in, the president appears to freeze. He was asked about abortion. He then pivoted to immigration. So abortion was meant to be the strength. He pivoted to the weakness. And then this goes on and on. And the moment where the president mumbles and the former president steps in and says the following: I really don't know what he said at the end of that sentence, and I don't think he knows what he said either. And if you look at the reaction of the sitting president, totally disengaged as that moment is developing right there on camera, on TV for all to see.
There's some real conversations that are evolving. I think Greg Valliere was talking this morning about actually dementia, about mental wellness issues. Either way, I think that Anne-Marie really did nail it. The fact that we're talking about this so openly and so many Democratic commentators are commenting about this, the cat's out of the bag in terms of a lot of confidence around him. Punchbowl put it best. 2024 reality sets in, and a lot of people are really awakening to two choices that many people do not want.
Absolutely. If you were trying to ignore this election cycle, you can no longer ignore it, especially if you're an investor in this marketplace. And if you weren't watching, it's a good point you made. There were moments where President Biden seemed disconnected. He was looking down. He looked off camera a lot of times. But even if he weren't watching the screen, his voice was soft. His voice was hoarse. Why didn't the campaign or the White House tell us before the debate that he was suffering from a cold? Why did that come 10 minutes into his performance? A lot of questions are brewing around this potential individual as the candidate.
Let's get down to Atlanta, Georgia, and we can catch up with Bloomberg's David Gura. David, you hosted a show yesterday evening. There was a big question going into it, and it was a pretty low bar for the sitting president. Could he deliver? Could he get through 90 minutes and put to bed concerns about his age? And David, I think most people this morning concluding he didn't do it.
Yeah, we had a spirited conversation yesterday, the four of us, about how pivotal this debate could be. And indeed, I think it's extremely pivotal. And you bring up those comments that we've heard from very establishment members of the Democratic Party expressing a lot of doubt and trepidation about this candidate in light of what we saw last night. And I think that does change the tenor of the conversation surrounding him as the presumptive Democratic nominee in this election. But it was astonishing to watch. I of course, wasn't watching it in person. I was in the media center. Nobody could be in the studio where the debate was taking place. But a very strange moment happened at the end of that debate. A lot of quiet as we kind of made our way down to the floor. And then all of a sudden, from each entrance, it seemed like we had surrogates for Donald Trump coming onto the floor, obviously very happy with the way that this debate had unfolded. And it took maybe 10 or 15 minutes before a Democrat made his way to the floor. California Governor Gavin Newsom finally came out. Georgia Senator Raphael Warnock was on the floor as well. But it was clear that in the aftermath of that debate, yes, there was soul searching, but also probably a very difficult conversation about what was the way in which they possibly could spin this as somewhat positive for the sitting president. I hear you mentioning that cold. I just don't know how much that's going to cut it. And these concerns that were swirling around him about his age and his competence and his fitness to serve another term in the White House, I think have really ratcheted up as a result of what happened last night.
Well, it's absolutely not going to cut it. David, you were in the room. The videos I saw were reporters swarming the likes of Governor Gavin Newsom. What are these individuals' responses, these people that are being floated as potential contenders that could step in if Biden were to step aside?
I talked to the governor last night before the debate, and we joked that nobody was enjoying the spin room more than Governor Gavin Newsom. I mean, he was swarmed by a throng of reporters, very eager to talk about the president's policies, very eager to say that he was fighting for the president's policies, talked about his travel schedule, how exhaustive that's going to be. You look at him and see him as a much markedly younger member of this Democratic Party and somebody who, of course, I think has presidential ambitions. And then you contrast that with the president. It is extremely stark. But even looking at those gaggles that took place after the debate, you had Gavin Newsom there, you had Raphael Warnock, a throng of reporters around them, but it was so large, reporters couldn't really have a give and take with those candidates. They kind of said their piece and moved on as a result. It was just clear, I think, from that dynamic, again, the imbalance of how many surrogates we saw for President Biden versus those for former President Trump, there was this recognition that this is a night that did not go by any means in favor of the sitting president.
It raises a question, David, since there have been so many opportunities and so many discussions around exactly this point over the past few months. Why is Joe Biden staying in the race? What is the conviction that's backing that in terms of not just the fact that he is the sitting president, but the fact that the polls are going south and that he is not reviving them?
I think that this is going to be a fascinating conversation, and there's going to be a lot of soul searching as a result of this. You mentioned Kate Bedingfield, his former communications director, and what she said on CNN last night, really reckoning with what had happened and critical of the way that he had been prepared for and indeed executed this debate. Joe Biden has been in politics for a very long time. He has a very loyal group of people surrounding him. We talk about Biden world, and the message that we've gotten for months up until this debate is he can do it. It kind of mirrored what we heard going into the State of the Union. Oh, you're worried about him? He's got this. When push comes to shove, he's going to be able to come out forcefully and show that he's the aptitude for this. That is the message that we heard from this group of advisors, again, that's been around him for many cases for many, many years. I think there's going to be a moment now where the Democratic Party is saying, what's been going on here? There's a level of political irresponsibility surrounding the way that I think his presidency and his candidacy has been framed in terms of how he's able to do these things. And I think the debate is a clear example of that. This was a debate that he wanted to have. You look at the stasis of this campaign, where the polls have been for so many months. This was supposed to be a thing that, in the eyes of the Biden campaign, was to shake it back to life, was to be a kind of pivotal moment when we move more earnestly into the campaign. It seems like it's actually moved in the opposite direction. It certainly didn't advance what they thought would be happening here as a result of this debate.
David, great work yesterday evening and this morning, sir. Thank you. David Gura there, down at Atlanta, Georgia. Just to pick up on that last line, it's the debate that the president wanted to have.
Exactly. This was something he called early to try to be a pivot point in his campaign. It was anything other than that. Now people are actually talking about fundraising even. Who's going to throw their money behind him, and some real soul searching within the Democratic Party.
Terry Haines of Pangea Policy has a bit of a different view on this. This is what he has to say. Our 2024 election view is unchanged post-debate, but the call is made with less confidence because neither candidate changed the game. In November, Biden likely wins by a nose. Terry joins us now for more. Terry, there are questions this morning, as you know, about whether his candidacy survives until November. Why do you take a little bit of a different view this morning?
Well, I just think you have to look at the debate in context. Look, I would firstly, I wrote and I would associate myself with everything that was said so far, so I don't want to reiterate it. At the same time, what you're seeing in pockets of the media, not here, but in pockets of the media, are people that were way over their skis in trying to validate and what now apparently is covering for Biden. And now they're kind of going the opposite direction and bedwetting on this to cover their own difficulties. So there's that. Secondly, I think you can't look, as bad as Biden's performance was, I think you can't look at it in a vacuum because you get a situation where Trump had a relatively good night, but at the same time, he's dealing with a split Republican Party, actual voters, not luminaries too, but voters, and lack of appeal to independents. And he didn't break out or make progress there. Any other Republican in that debate against Biden, there would be voters flocking to the Republican candidate. That's not the case with the Trump, and it's probably not going to be the case. Thirdly, I'd say, in short attention span theater land, now we're going to get on to the Trump immunity case, Trump sentencing, the political conventions. This becomes part of a continuum that, we don't know how the polls are going to shake out. The polls have been way ahead of official Washington on a lot of this stuff. Finally, you got a situation where markets are understandably concerned about the direction and how they bet on this election. My point to you is that 70% likely right now what 2025 Washington's going to look like, and it's regardless of who the president is. You're going to have a split Congress, so you're going to have basically a lot of status quo.
Terry, Greg Valliere this morning writes something that, frankly, I'm receiving a lot of messages about. Our tentative bottom line is that Biden will drop out within days, whether you like Biden or not. It was a sad sight last night as this once dynamic figure stared off into the distance with the look of a very tired and lost old man. Terry, is this possible? Is there a chance Biden looks at last night, his team looks at last night, and they say, we need to get ahead of this before August, before the convention, and step aside?
I share the sadness. I don't share the view that Biden will drop out within days. Biden's worked his whole life to get here. He's not going to lose his grip on the office lightly or quickly. People should understand that. And that people should also understand the vast majority of the Democratic Party is not interested in embarrassing itself, and a quick flip on this stuff based on one debate performance would be exactly that. It would be a panic move that would, frankly, I think outstrip what went on in the debate last night, not look good for the Democrats or whoever their candidate is. So I think that's very, very unlikely, and I don't think that's what Democrats will do. I think Democrats will end up closing ranks, trying to figure out new ways in order to highlight Biden's sentience and energy, double down on the line that it's a cold and it's this and it's that, and move forward as best they can.
Terry,
the strategy had two components. One, an early debate would be good for him, and secondly, if it wasn't, they had a lot of time to correct it. So now here we are.
Terry, sorry to jump in here, but you said flip on a switch. This isn't a new discussion. This has been going on for months and months. David Gura put it really well when he said there is a question around political malpractice that hasn't been addressed more concretely earlier, that is being left up to this moment that was set up by him as a pivotal moment. Right. How do you address that kind of concept that it has been sort of misadvisement that should be course corrected versus just allowed to keep going? How would you respond to that?
How I respond to it is I was, I think, one of the first to raise this as a real issue, even last year. got a lot of buckshot for it, frankly. We've all discussed this on this program and others for months. So, you all have been, I think, well ahead of the curve, and I've been raising this as a real issue. Voters think it's a real issue. The places where it hasn't been a real issue is kind of inside the Beltway, official Democratic Washington, and in supporters in pockets of the media that have been enablers for that view. So, I think they're now scurrying to catch up more than anything else. But I think people should understand that panic is in part self-inflicted for that very reason.
Certainly a reality check for them this morning. Terry Haines of Pangea Policy. Terry, appreciate your perspective. This in from Politico. Democrats waking up to a nightmare. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israel and Hezbollah are heading closer to a full-blown war in Lebanon. A steady tit-for-tat between the two that started October 7th has been shifting into something more alarming. Record numbers of Hezbollah projectiles have hit Israel this month, while Israel carries out deeper and more destructive attacks in Lebanon. Tens of thousands of residents have been driven from homes in both regions. Thousands of HSBC UK customers have been unable to access their online and mobile banking services. According to Down Detector, the bank saw major outages beginning in the early morning. In a post on X, HSBC acknowledged the widespread issue, saying its IT teams are working to restore service. Online card purchases can still be verified via text message. And a check on Nike this morning, shares tumbling 14.7% to the pre-market. Its full-year outlook fell short of expectations. The company said revenue would decline in the mid-single digits this fiscal year. Nike has been struggling to churn out lifestyle wear with little offerings to replace top sellers like Air Force Ones and Dunks. Instead, rivals have been picking up the slack, like Adidas, whose retro Samba sneaker are fueling a new era of growth. And that's your Bloomberg Brief. John.
Nike just not in the game. More on Nike a little bit later this hour. Up next on the program, wrapping up Q2.
We are in an era of stories, more so than we've been in a very long time. As far as I can tell, the NVIDIA story is going to last for years.
That conversation just around the corner, and why the S&P could hit 6K before the end of the year. That conversation up next. Live from New York City this morning. No drama in this market, plenty of drama elsewhere. More on that a little bit later. Equity futures positive by 1/3 on the S&P. Under surveillance this morning, wrapping up Q2.
We are in an era of stories, more so than we've been in a very long time. As far as I can tell, the NVIDIA story is going to last for years. Some of these stocks, NVIDIA, Apple, Microsoft, represent very large percentages of the S&P. And so the normal risk parameters that apply to constructing portfolio don't necessarily apply to these.
So here's the latest this morning. The S&P 500 heading towards a third straight quarter of gains. Julian Emanuel of Evercore raising his year-end S&P price target to 6K. Writing this, 7,000 is possible by year-end 25. AI has permeated the consciousness of corporate America. This is a huge inflection on what we continue to view as game-changing technology. Julian joins us now for more. Julian, good morning to you.
Good morning.
We might navigate our way through some politics in Washington a little bit later in the conversation, but I've got to start with this price target of 6K on the S&P 500. When you put this out in the last week or so, how did clients respond to it?
Clients who know that, for the most part, we have been concerned about valuation on the one hand, yet have been, I would say, among the largest proponents of the game-changing nature of AI for well over a year now, really were sort of receptive to the fact that it was an introspective moment on our part. But we did the work, and basically, when you go back and you look at similar high-priced valuation regimes, valuation alone is not a reason to sell stocks. And when you've got a Fed that is really looking forward to cutting rates when it can. And you look at this morning. Let's step back for a moment. We'll start the political conversation maybe a little earlier, John. Is that you've got the uncertainty of what we saw last night. You've got a disruptive event in France coming this weekend. And you've got the world's most iconic footwear maker down 14%. And the market is rock solid this morning. something else is going on.
All right. So you talk about the length of an expensive market. You talk about how it could be a prolonged period of time, almost 2 years. And the current expensive market is only 6 months old, so it's got more time to run. Wasn't Micron a reality check from that? That if there is any kind of lack of increased target expectations, the world falls apart, you see everything fall out of bed?
So it wasn't. I mean, if you look at the narrative, it's basically, that's traditional chips. That is not AI enhanced, supercharged, 2024, 2025 semiconductors. And essentially, the market, again, took it in stride against this backdrop of just incredibly ample liquidity. And from our perspective, part of what we do is sort of look to see if there's a bubble psychology forming. And when you think about, sentiment levels, you think about IPO activity, M&A activity, we're not concerned about the bubble aspect yet either by any stretch of the imagination.
Julian, let's get to the politics sooner than maybe we normally would. We had Steve Eisman on the show saying it doesn't really matter who's president. You can ignore this. Buy NVIDIA. Can you ignore moments like yesterday evening?
The market's telling you that at the moment you can. And I think that there's a rational response here, okay? If you look at the state of the equity market, and again, this subdued bullishness, but yet bullishness nonetheless, what this is really a recognition that after 2 years of essentially no earnings growth, we are back to an earnings growth pattern, both from a revenue perspective and from this ongoing ability of corporate America to control its costs. And frankly, AI over the long term is going to give even more power to corporate America to increase revenue and control its costs.
There's a great line in your research in the last week when you upgraded the S&P 500, the persistence of exuberance. The persistence of exuberance. What did you mean by that when you put that in?
Well, again, this is part of getting our arms around this high valuation regime. If you look back at these past regimes, they lasted 1.5 to 2 years, and you saw gains once stocks became expensive, and by that we define 20 times trailing earnings, which this one passed in January, of gains of 40 to 60%. Now, could there be payback? Absolutely. But again, that payback is a function of either a bubble forming or a recession directly on the horizon, and we don't see either of those at this point.
How different are U.S. markets than, say, France? And the exuberance that you talk about in the U.S. versus the outflows that we're seeing from French assets ahead of the election that begins on Sunday. Is there a sense in your mind that because of the AI developments, the U.S. is immune to political risk in a new way that people are not accounting for?
Well, and again, this is the kind of thing, and I go back to this valuation paradigm. It doesn't last forever. We have to be conscious of that. The apple cart, there are no sort of overt signs of disruption. But look, America has benefited by being on the vanguard of technological development. This is a growth-centric market. Europe tends to be a value-centric market in the main. And this is the place where capital flows to, particularly in times of uncertainty. And when we think about the global political point of view, there's lots of uncertainty.
It's a unique privilege, and I'm so pleased you brought up this story, Lisa, because I can only imagine what the fallout in French markets would look like if those two individuals yesterday evening were French. We'd be talking about governance issues. We're talking about fiscal sustainability and what it's going to mean for French bonds. You are not having those conversations this morning in America, and the Treasury market's totally unmoved by it.
We would see Treasury yields surging because that's exactly what happened in France, in the French market. We saw the biggest outflows in many months from French markets as a result of what we've seen over there. How different is the United States politically? And how different is it not because of the actual fiscal policy, but because of the privilege that you talk about on the global stage?
Based on the price action, it's very different. Julian Emanuel of Evercore is going to be sticking with us. He mentioned Nike. We need to talk about it. It's getting absolutely hammered in the pre-market. We're down by almost 15%. That conversation up next. 3 days of gains on the S&P 500, looking to make it day 4, the longest daily winning streak going back to the middle of this month. Futures up by 1/3% on the S&P, on the Nasdaq up by 0.4%, heading towards a 4th week of gains and another quarterly gain on the benchmark in America. In the Treasury market, 2-year, 10-year, 30-year looks a little something like this. The 2-year, I believe, is up on a quarter. It is down on the month, and maybe the month is more instructive, Bramo, than the quarter, because the last month has been about weaker than expected economic data, and really starting to rethink what this Federal Reserve's going to do before year end.
It's backing away from this idea of higher for longer and possibly never landing, and this whole idea that the Federal Reserve was going to be really determined to hold rates high. The idea of an equal risk that inflation was going to reaccelerate as growth really threatened has taken the main stage.
A question we have in America this morning: do politics matter to financial markets? If you're French, absolutely. Switch up the board and look at the spread between the German 10-year and the French 10-year. That spread, Bramo, is through 80 basis points. We're at the wides of the year.
And basically, you're looking at the idea of the biggest spread between these two yields going back to 2012. Meanwhile, when you look at outflows, Western Europe recorded its first week of outflows since November of 2023, just highlighting how political risk does matter, just evidently not in the United States.
Big first-round vote coming up a little bit later this weekend. More on that story later on. Under surveillance this morning, front and center in America, Democrats in damage control mode. President Biden's performance in his first debate against Donald Trump, raising doubts over his candidacy and really raising questions about whether that first debate is the last.
This was supposed to be a recalibration. Biden was supposed to put to bed these questions, these whispers, if he's up, robust, ready for another 4 years. All it has done is aggravated those concerns. What you hear from the White House and campaign officials is that it's a double standard. Trump is just almost as old as Biden, yet what they've done, what many are calling, is political malpractice, because they put him forward in front of the American people when clearly he was not ready, looking off to the distance, one issue, a raspy voice, losing train of thought, and at moments, clearly, physically, almost freezing on camera.
Yeah, well, we've got 5 months. We've got 5 months until the election.
Does he have 5 months?
That's a great question. And right now, it's looking like less and less. When you look at Predicted, still the pricing of that sort of expectation of his running is about 62% chance. Gavin Newsom is at 21%. Kamala Harris is at 13%, according to this prediction market. I'm looking out, and I just keep thinking about this from Punchbowl. 2024 reality sets in. We are looking at an election that's kicking off at a time where an increasing number of people are extremely unhappy that these are their choices.
I like to look at two individuals who are friends of the show, Greg Valliere and Terry Haines. This morning, Greg Valliere, our tentative bottom line is that Biden will drop out within days. Terry Haines of Pangea says unlikely. That actually looks like panic. That looks even worse than what they need to come out and do. But the question is, what do? They need to make a massive move, because there's not another debate until September. And all of these moments of Biden looking confused and losing his train of thought, that is going to persist on social media and on television until that next debate.
Let's run with that word panic and draw a major distinction. A distinction between what's happening in the political world and what's not happening in financial markets. There might be panic in the Democratic Party. There is no panic whatsoever in financial markets this morning. I would expect, just to throw this in, I would have expected maybe the dollar to start rallying a little bit more on the prospect of Trump getting a big win in November, running away with it and doing something big with trade policy, which Deutsche Bank has already come out and said would mean big things for the US dollar. Adam Poston's already come out and said it could mean rate hikes in 2025. Not seeing that this morning either, and I'm trying to make sense of that too.
You just think about the people who've come on this show, whether it's Jay Pulaski saying that the currency is going to tank, versus we heard from Steve Eisman saying everything's going to be incredible. If Trump wins, you're looking at just a complete difference in opinion about what the outcome will come, depending on who the actual presidential winner is, as well as potentially the makeup of Congress.
Or is the market thinking this is 1968? This is Lyndon Johnson, and Biden will step aside, because these conversations are now not just happening behind closed doors and whispers. They're happening out in the open. Following the debate, did you flip through CNN, MSNBC, individuals openly talking about how uncomfortable that was to watch?
Left-leaning networks that can't avoid what everyone could see for themselves for the last 6 months. And I think that's the issue that Terry Haines been getting at in the last 30 minutes or so. Who's surprised by this? For a lot of people that get the phone call, maybe they run into a pollster and they ask them, what do you think about this? This has been shown in the polls now for the best part of 12 months. It's been certain segments of the media, and this is Terry Haines' point, that have been spinning a very, very different story that couldn't spin it anymore after that performance yesterday evening.
This is what happens when you get tribal politics. When you have basically certain things you cannot say if you are part of a political party and certain things that you can say. And you have that on both sides of the aisle where people are not willing to challenge the status quo. And you've seen that get more and more entrenched. And a lot of people have been talking about that particular dynamic and how that could potentially change.
There is a little bit of economic data coming up later for those of you interested. I'll throw that in there. 8:30 Eastern time. We'll get the PCE deflated, a Fed's preferred inflation gauge, plus personal income and spending data, followed by UMich consumer sentiment data at 10 a.m. Eastern time. Before we get there, we need to talk about this as well. Shares of Nike getting absolutely hammered in the pre-market. The company's full-year outlook missing estimates, reinforcing concerns about waning demand and increased competition. Poonam Goyal of Bloomberg Intelligence joins us now for more. Poonam, we're down by close to 15%. Can you help us understand what is a market issue and what is a Nike issue? Because this feels like a Nike issue.
It absolutely is a Nike issue. The problem is innovation here. They pulled their foot off the pedal about a couple of years ago since the pandemic, and they really haven't brought out enough innovation to compete with the competition and to suffice customer demand. Now they're working on it, but it's going to take time, and it's going to be a painful year to watch them try to come out of this and really bring forward more innovation than their competition.
Poonam, when you talk about innovation, I'm thinking of running. I am a runner. I know many people who are runners. They don't think of Nike as being anywhere in the circuit, have not been catering to them. And instead, you see Hoka, you see On Holding, you see all of these other brands that have managed to get the front stage. How do they get that back, and where do they go wrong?
Well, Nike is still a leading brand in running. So yes, you have heard, and you are probably seeing more Hokas and Ons on people's feet, but it still remains a dominant shoe for running. That said, you're absolutely right. They need to bring back innovation. They need to become more hip in running, right? They need to have performance. They need to improve their styles. And they're working on it. I think we're in this phase where things are looking ugly because they're just starting to really push forward on innovation. And to see that come through will take, I think, at least 6 to 12 months.
Poonam, appreciate your input today. Stock is down hard. Poonam Goyal there of Bloomberg Intelligence with that name down by double digits in the pre-market. This following a big move yesterday as well on another name, Walgreens. Lisa, you were all over the story as soon as it dropped. We closed yesterday negative 22% on that retailer.
Dragging down other potential drugstore providers as well with it, with the closure of a significant portion of their 8,600 stores around this country, raising questions about, is it a Walgreens problem? Is it a consumer problem? A lot of people say not so much. Or is it just a model problem, given the theft, the way that they've dealt with it, and frankly, the fact that Amazon is eating their lunch?
Julian Emanuel of Evercore is still with us. Julian, when you see moves like 22% on Walgreens, double digits on Nike, can we just keep sitting here and saying, idiosyncratic, or do we have a broader issue at play?
No, we actually can say that it's idiosyncratic. And actually, one of the things that had concerned us until recently is this incredible dynamic where the correlation amongst stocks, not just the S&P 500, the entire universe, the Russell 3000, has dropped to all-time lows. Okay. Normally, if you look back the last 5 or 6 years, that had been sort of the precursor to a correction. But the degree to which that has happened in recent months is so different that it actually calls to mind the potential, and this is part of sort of what our upside, if a bubble starts forming, you could get to 6,500 dynamic would look like, is that you actually have more correlated moves where all stocks start rising, like the end of 1999. But again, the fact that you could have this report down 14%, the largest, one of the largest pharmacies, tanking to that degree, it says that investors are absolutely not patient for stories that aren't working, but that the pickings of stories that are working are very, very, voluminous.
It also shows that there isn't a presiding narrative and that people aren't sure. This isn't, rip-roaring growth, but it's certainly not recessionary moment. And that's sort of what we felt come back into the zeitgeist, as John was talking about over the past couple of weeks. Suddenly, weakness seems like it is more on the forefront than, say, the chance of some sort of resurgence in inflation. So what happens if that weakness becomes more pronounced?
So when you think about all this noise that we've been talking about, and all the political volatility globally, you really can get a sense for why the market is much more comfortable with not really caring whether it's 6.5 rate cuts at the beginning of the year or 1.5 or 2 now, but more the fact that actually the Fed is looking awfully smart in stressing the concept of data dependence right now. But the market believes that however the data unfold, that the Fed will either exercise restraint appropriately and wait for the right time to cut, or, to your point, if the slowdown looks like it's accelerating, they'll be there front and center.
I'm trying to tap into a very simple underlying message, which I think you're trying to explain over the last 30 minutes or so. Are you saying just buy the index and sleep well at night on the S&P 500 for all the talk of concentration risk, given your price target, given everything you've said, given the fact we can see these 20-25% moves elsewhere and the index level's just there, rock solid, wouldn't know anything's going on? Are you saying just do that?
No, because actually, if you look at it, this low correlation environment is really good for active management. That's the first thing. A lot of people, yes, it is appropriate to own index exposure solely. But from our point of view, the market's bifurcating in a way. Look, we have to come to grips with the fact that there are only 2 sectors that are outperforming the S&P 500 this year. Communication services, we know who's there, and infotech, which we recently upgraded. Our view is you need to be there, but you also need to be in the defensive sectors, healthcare and staples, because if we get the slowdown, those companies will be more immune to the slowing econ.
Julian, fantastic to see you. Julian Emanuel of Evercore on a range of issues, but ultimately with a price target of 6,000 on the S&P 500 for year-end. Later on in the programme, we'll talk about concentration risk. Bramo, just to go through some of these stats from Liz Ann Sonders at Charles Schwab, only 17% of the S&P has outperformed the index over the last year. On the NASDAQ, that number is much worse. That number is 11%.
Just going through the overall full year so far, year-to-date averages, S&P is up 15%, NASDAQ is up 19%, the Russell 2000 up 0.6%. Even within the Magnificent Seven, you see such incredible dispersion with Apple up 11%, NVIDIA up 150%. So you put this together, you raise a great point. Why not just buy the index if you've got these pistons that are kind of firing, countering each other? Well, I mean, you could just count on them rather than trying to do the work yourself.
Liz Ann coming up at 8 o'clock Eastern Time. Look out for that conversation later on this morning. Julian's saying that's not the message he's sending, just for the record. Just for the record.
He's laughing at
Let's
me.
give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Vladimir Zelensky has signed a long-term security commitment with the European Union. The deal formalizes EU initiatives to support the nation. That includes arms deliveries and training for Ukrainian troops. Earlier this week, the EU formally opened negotiations over Ukraine's membership. L'Oreal is expecting slower growth for the beauty market this year. Weakness in China is weighing on their sales. L'Oreal told investors that they see the global beauty market growing between 4.5% and 5% this year. That high end had been their base case previously. The CEO says the downward revision is thanks to a flat Chinese market, which had long been a growth engine for L'Oreal. Shares are down nearly 10% this year. Microsoft has told customers that their emails may have been accessed by Russian hackers. In January, Microsoft had disclosed that senior leaders' emails were stolen, but now the company is acknowledging that the hack was more widespread than first thought. Microsoft has been dealing with strong condemnation by the U.S. government for security breaches, with the company now undergoing one of the biggest security overhauls in decades. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, playing the inflation blame game.
We're working to bring down the price around the kitchen table, and that's what we're going to get done.
He inherited almost no inflation, and it stayed that way for 14 months, and then it blew up under his leadership.
That conversation just around the corner, live from a beautiful New York City. This is Bloomberg. Equities doing okay, positive by 0.36%, up about 1/3 this morning. In the bond market, yields a little bit higher by 2 basis points, 430.78. Under surveillance this morning, playing the inflation blame game.
We brought down the price of prescription drugs, which is a major issue for many people. We're working to bring down the price around the kitchen table, and that's what we're going to get done.
He has not done a good job. He's done a poor job, and inflation's killing our country. It is absolutely killing us. He inherited almost no inflation, and it stayed that way for 14 months, and then it blew up under his leadership.
So here's the latest, just over 90 minutes away from the PCE deflator. The median estimate in our survey calling for another month-over-month decline. Lindsey Piegza of Stifel pointing to slowing consumer growth, writing this. Will a cooling of activity be accompanied by ongoing inflation relief? If so, the Fed can continue to focus on eventual easing. If not, an ongoing loss of momentum, coupled with still elevated price pressures, may result in the feared scenario of stagflation. Lindsey joins us now for more. So, Lindsey, I guess two-part question for you. What are you looking for at 8:30 Eastern Time? And ultimately, based on those two options, what's your base case?
Well, we are looking for further improvement in terms of the disinflationary trend, getting us closer to that 2.6 level, both on the headline and the core. But even with further progress, while welcome, it's still not enough to justify a top-line move in terms of monetary policy. Fed officials have set the bar relatively high, suggesting they need many months of improving data to really instill the level of confidence needed to adjust policy from that sideline position. And I don't think there will be enough in this morning's report or by the end of the year to get that first round rate cut.
You offered up two scenarios. I want to pick on the second one, an ongoing loss of momentum coupled with still elevated price pressures. If we got that result, if that was the outcome, let's just do some scenario analysis. Do you have a decent understanding of how the Fed would respond to that?
Well, it depends on how deep the loss of momentum would be. Right now, we're talking about the U.S. economy slowing from about a 5% pace in the third quarter of last year to over 3% by year end. We're now down to less than 2%. Quarter-to-quarter volatility aside, of course, we do expect to remain in this 1.5% to 2% range for the year. But the question really comes down to what happens when we turn the calendar page into 2025. If we continue to lose momentum to a non-accelerating pace, or at least fall below the bare minimum that we should expect for a developed economy, but the Fed is continuing to tolerate above target price pressures, at that point, I think we see a scenario of the Fed persistently on the sideline. But if we do see an outright decline in activity, so now we're talking about negative growth, price pressure is still elevated, at that point, the Fed may be willing to move the goalpost for inflation, saying right now it's more important to provide additional policy easing or even support, while somewhat, not necessarily ignoring, but putting the idea of price stability behind the need to supplement growth.
Lindsey, we've been talking a lot this morning and we'll continue to about the politics of the moment, given that we really are getting into the heat of the presidential election season. And I'm wondering if you could give us a sense of how much fiscal policy led to the pop in inflation, how much that continues to basically keep prices afloat to this day. Can you give us a sense of that?
Well, I think it's obviously a combination of fiscal policy and monetary policy, but it should come as no surprise when you talk about pumping trillions upon trillions of dollars into the marketplace, resulting in an excess of $2.5 trillion in terms of savings, not to mention growing the money supply by nearly 40%, that there will be inflationary consequences. While the rest of the world was reeling from the supply side of the inflation equation, remember here in the U.S., we ignited that demand side as well, resulting in roughly the highest levels of inflation here in the U.S. than anywhere else in the developed world. And so it's very much a fiscal policy scenario, but it was exacerbated by the Fed's inability to recognize the lack of transitory nature of inflation. Remember, we had crisis level accommodations still in place in March of 22. Now, certainly the economy was still faltering. We weren't talking about a robust economy. But it was very clear at that point we were beginning to talk about a recovery process, and it was no longer appropriate to have that crisis level accommodation in place. But the Fed was very fearful about undermining the economy and buying into that notion of transitory well beyond what was appropriate.
Some people argue, Lindsey, because of that fiscal stimulus, it is also the reason why the U.S. consumer has remained as robust as it has. Given that, how quickly is the fiscal impulse fading? And how quickly will it continue to as a potential driver of inflation? And, are we going to start to see personal income outpace personal spending with some of that pandemic era stimulus being used up?
Well, most of the fiscal stimulus has largely concluded. There is some fiscal savings still out there, but most of that has been spent. As quickly as that arrived in Americans' mailboxes, we were willing to go out into the marketplace and buy goods and services, take that vacation, buy that new car. That being said, the consumer didn't fall off a cliff when we concluded that fiscal stimulus, and that's because there was some additional pandemic savings. But we've also seen consumers turn to other inorganic measures, an intergenerational wealth transfer, or consumers turning to 401ks with hardship withdrawals up double digits since the start of the year. And of course, surprise, surprise, turning to credit cards with outstanding balances over $1.1 trillion. But that being said, we've also seen some organic support to the consumer, which is more of a welcomed, potentially medium or longer term support to the consumer scenario. With disinflation setting in, painfully slow, but setting in, we have seen real wages turn positive. So there is some ongoing support to the consumer that can continue to perpetuate this resilient thesis, even now in the absence of that fiscal stimulus.
Lindsey, yesterday we didn't get a ton of substance, but we did hear the candidates talk about tax cuts, entitlement spending, tariffs. Do you have a sense, a base case of what we can see fiscally in 2025?
Well, I think regardless of the candidate that comes into power, we're going to face a number of challenges in this country, turning the page into 25. We're going to continue to face sizable labor shortages. We're going to continue to face a massive divide between asset holders and non-asset holders. We continue to face elevated prices, massive budget deficits, not to mention international and geopolitical risks. So in many ways, the U.S. economy is poised to face sizable challenges, regardless of whether this is a second-round Biden or second-round Trump administration.
Lindsey, wonderful to get your view on the programme. Lindsey Piegza there of Stifel. A final word there on fiscal policy in 2025. We could talk about fiscal policy in 2024 in France. That sell-off in French bonds going into the weekend continues. That spread between France and Germany now gapping out to about 85, 86 basis points this morning, Lisa.
And this comes as the French 10-year yield rises to the highest of 3.3%. That is something coming out of basically the political uncertainty in that region that's frankly been dragging down all of Western Europe assets. This question of, is this sort of existential for the Euro region? How much does this really highlight the populist trend? And how different is that region than the United States?
There's so much political uncertainty and governance issues in places like France, places like the UK in the last couple of years, places like the United States. But to your point, the distinction I think we're all drawing this morning is there's very different fallout in places like France, in the gilt market of a year or so ago, than we're seeing, say, in treasuries.
It's a much bigger market in the United States. And honestly, Julian and Emanuel nailed it. The United States is a growth market. It has been the home place for a lot of the big tech behemoths that have been driving a lot of innovation. Can it continue to be the leader? You wonder how much the new ambassadors are the leaders of NVIDIA, are the leaders of Amazon, are the leaders of Apple. And you see that again and again. And why? Because those are the companies that are actually driving U.S. exceptionalism, not the political sphere.
Let's talk about some of the companies that aren't. Nike in the pre-market down about 15%. That's your bolting horse. Here are some barn doors for you. Price target, Nike cut to 90 from 100 at Jefferies, to 81 from 99 at Truist. Neutral, that's the new move, cut over at UBS. Price target 78, just repeatedly just dropping headline after headline in the last 12 hours.
I mean, you think about how much Jordans cost. You think about how popular they were just 3 years ago with many people's offspring, including mine, looking to spend astronomical amounts on them and then walking like they were on the moon to keep them from getting creased so they could resell them. That era has shifted. You now see other shoes in the forefront. And when it comes to Nike, they aren't able to regain that in the sports world, in particular with running.
Yeah, you mentioned this earlier, and you're right. Let's park the Air Jordan stuff. This is about the bread and butter, the roots, the foundations of this company. It's running. There's been a boom in running, and they've not been a part of it at all.
There was an anecdote that I was reading from a runners club, and they said that Hoka and On, they had their representatives at their meetings. They gave them free food after their runs. They gave them free drinks. They said, here, try these out. And guess what? Hoka and On are the new running shoes. And you see that consistently across every running group that you see in Central Park.
You see it in the share price year to date, On holding up 44%. Nike's down about 13%. You're going to get more pain a little bit later around the opening bell, given the indication we're getting in the pre-market and the early pre-market performance. Coming up next on this programme, in the second hour of Bloomberg Surveillance, we'll catch up with Pimco's Libby Cantrill. We'll speak to Bob Dole of Crossmark, former World Bank President David Malpass, with lots to say on fiscal policy in America, and Morgan Stanley's Michael Kushma. All of that still to come in the second hour of Bloomberg Surveillance, live from New York City this morning. Good morning.
Generally speaking, the trend in inflation is lower.
I really don't think inflation is going to pick back up. I think that it's slowing, it's going to keep slowing.
Markets, trying to figure out what the Fed's going to do next, and it's pretty difficult because it's very much data dependent.
There's a lot of data between now and September. If we see inflation coming down, if we see the labor market continue to cool, they're going to go in September.
We think things should slow down. We think inflation's coming down as well, and taken together, that allows the Fed to cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with the equity market positive by 1/3% on the S&P 500. There is one word you've heard repeatedly over the last 12 hours associated with Democrats. Lisa, that word is panic.
Panic after a sad debate, and a lot of people saying that right now there are a lot of questions within the Democratic Party about whether Joe Biden has the resilience to run to have a second term, let alone to serve all 4 years if elected.
These comments were whispers behind closed doors, and now the Democratic Party is having these moments, this conversation with themselves out in the open, which is why many people are saying this is malpractice that they got to this point. This debate was supposed to be a moment of recalibration for the president, and all it's done is aggravate the concerns about his age at 81 years old. Can he do another 4 years?
It is late June. It is early to be having these discussions, but we're having these discussions because he wanted to have this debate in late June. He wanted to have this debate as early as we've just had it.
He wanted to turn the sentiment, and the question now is, how high is the bar within his own party to turn the sentiment in his camp? To turn the sentiment about how feasible it is, and whether the popularity right now in the polls, the Snap poll from this election saying that 67% of that Snap poll by CNN saying that Donald Trump won that debate, is that enough to be a gut check for the people around Joe Biden to really say, wait a second, we need something else to figure out how to proceed?
We have already drawn a pretty strong distinction, a difference between what is happening politically in America and what isn't happening in financial markets. Markets are doing okay. There's no drama on this screen this morning. Where you are seeing a little bit of political drama, it's over in France. It's a completely different story. When you have political risk come to the surface in places like France, you see it in their domestic market. You see it in French bonds this morning.
You can see the yield on French bonds, the highest relative to German bonds of the similar denomination going back to 2012. So here's the question. How different is France from the United States? How vulnerable are they to some sort of increased spending and increased deficit in a way that the United States is not? And how much does this have legs? This is sort of a question. We've talked to a lot of people who say they're investing in France. Okay, at what point do they actually step in? Because right now we're seeing outflows, and right now we're seeing that yield continue to gap out.
Will the United States retain that unique privilege of being able to behave recklessly for another 1, 2, 3, 4, 5 years, even decades?
Julian Emanuel nailed it. He basically said that so far it has been the big tech giants and the growth kind of energy of the U.S. economy that has allowed the U.S. to remain immune to a lot of political risks. Does that change is really a key question, especially at a time where there are some real policy shifts on tariffs, where there are real policy shifts on taxes. And these are some of the issues that we did not hear about last night, even though a lot of us wanted to.
We did hear about it slightly on the margins, a little bit of substance, but really yesterday, of course, was about style. Of course, the other issue and the big question, and this is a feature of the U.S., not necessarily a flaw, is that we need the makeup of Congress as well to know how much we can see whether or not it's Trump or Biden. What can they enact? What kind of fiscal spending can they do? It really depends on Congress for a lot of these questions. And maybe that's a check right now. And maybe that's what the market's also reading into.
The biggest debate we had yesterday evening was over golf handicaps. For those of you that missed this debate, that was the biggest debate. The most heated that debate actually became was over their golf handicaps.
They actually looked at each other and engaged when they were talking about their golf game. Not taxes, not foreign policy, not inflation, not the border, their golf game. They looked at each other and they said, I'll meet you on, what do you call it, the pitch?
No, but we'll leave that there. The course. The course. Maybe leave the sporting analogies behind, AMH. OK, I'm going to move on. Equities right now in the S&P 500 look a little something like this. Equities at the moment positive by 0.4%. If Biden can come back from that, you can come back from that too. Coming up this hour, we'll catch up with Libby Cantrill of Pimco, breaking down the first presidential debate. Bob Dole of Crossmark ahead of the Fed's preferred inflation print, and former World Bank President David Malpass on the economic consequences of the election. We begin with our top story. President Joe Biden and former President Donald Trump clashing in Atlanta, and the Democratic Party is looking for a backup plan.
We had the greatest economy in the history of our country.
Unemployment rate rose to 15%. It was terrible until we get the total ban on the total initiative relative to what we can do with more Border Patrol and more asylum officers.
I really don't know what he said at the end of that sentence. I don't think he knows what he said either.
How many billions of dollars do you owe in civil penalties for molesting a woman in public, for doing a whole range of things, of having sex with a porn star on the night while your wife was pregnant?
I didn't have sex with a porn star.
The only person on this stage is a convicted felon is the man I'm looking at right now.
When he talks about a convicted felon, his son is a convicted felon.
You're the sucker. You're the loser. Dealing with everything we have to do with, look, if we finally beat Medicare.
Libby Cantrill of Pimco joins us around the table. Libby, how does the President of the United States come back from that?
Well, that is, I think, the question for a lot of Democratic strategists and for the White House. Interestingly, John, even though I think we all saw the same debate, and arguably the president really did not meet the very low expectations that were established for him by President Trump. The Biden campaign is acknowledging that he, as Vice President Kamala Harris said, he had a slow start, but he finished strong. This is one debate. There will be another opportunity for another debate on September 10th. I doubt that debate happens at this point, honestly. So I think that they are, they are at least indicating that this is going according to plan. And I just think from a process perspective, it's really important to keep in mind here that there is no, party elder in the back room smoking a cigar deciding who the next Democratic nominee is going to be. This is Joe Biden. Joe Biden will be the nominee unless he steps down, unless he decides really in the next 2 weeks or so that he is no longer going to run. That has to be his decision. That is nobody else's decision. That is not the donor's decision. It is not the Democratic strategist's decision. That has to be Joe Biden's decision. And then even then, there is no consensus candidate. So the thing that the Democrats risk here is that they don't, if Joe Biden does decide not to run, that there could just be chaos, and that then undermines their whole pitch to the American people that they are the party of stability. But it was very objectively an incredibly bad night for the president.
You've indicated to us repeatedly that a lot of the questions you get asked is about who is going to ultimately be the candidate for the Democrats. And the words that you hear repeatedly from clients is not Joe Biden. You hear things like Michelle Obama, even Jamie Dimon, I think you shared with us a number of months ago. What do those conversations sound like now, particularly yesterday evening?
Yeah, well, I would say that our traders had lots of had lots of views last night, and were sharing them with me, in a very generous way. I would put it that. I think that of course that narrative, John, is going to reach a fevered pitch if it hasn't already. I just think people have to really understand, though, that there is a process here that the Democratic Party has established, and they have put their thumb on the scale. Joe Biden is going to be their nominee again, unless the president of the United States takes him out. This can only be his decision. I just can't reinforce that enough. So, yes, I do. I think that the narratives around Michelle Obama and Jamie Dimon are going to just accelerate for sure. But I don't think that changes the reality that this is likely what this is. And if it's not going to be, the decision has to be made really within the next week or so.
Libby, you brought up the fact that Biden camp is saying he finished strong. Arguably, he didn't. He didn't even end with a real pitch to the American people, didn't bring up abortion, which is supposed to be all this money they're going to spend on to try to get out the vote. At the same time, I'm sure your phone was blowing up like mine, with Democrats saying this is an unmitigated disaster. Do you see a schism now between Democrats and the White House and the campaign?
Well, I do think that the down ballot Democrats, and we've talked about this before, that of course the Democrats are much more vulnerable in the U.S. Senate. They only control the Senate by one vote right now. 23 of the 34 seats are being defended by Democrats. Of those 23, 8 are vulnerable. So for those folks, Anne-Marie, who are in these vulnerable races in the Senate and then also in the House, of course, I think that the Democrats are hoping that they can flip the House. There is a lot of concern that even though the polling shows that those Democrats are actually outperforming Biden by a pretty significant margin, that Biden's performance last night will just continue to weigh on not only on him but on their candidacy. But again, I just think this is. The reality here is this is very difficult to change at this late in the game. This was not some sort of, again, just to go into the conspiracy theories, this was not some plan by the Democrats to show Joe Biden's weakness and then to try to change the ticket. I think this was a mistake. This was sort of a political miscalculation. They really were, as you said earlier, they were really trying to reset the race. They wanted this. They set the terms for the debate. They were hoping that this would be able to recalibrate, and it's not. And I think from a market's perspective, let's see what happens. I mean, there was some discussion about tariffs yesterday. There was some sort of brief discussion about deficits. I didn't hear anything about that either candidate is going to be, there's going to be any fiscal consolidation, right? They did not talk about deficit reduction. Only thing they did talk about was reinforcing the importance of Medicare and Social Security and not touching those entitlement programs. And as we know, that's a big source of the deficit. So maybe the market starts pricing in some of the tariff risk that they've been sort of ignoring at this point. Maybe yields, maybe the yield curve starts normalizing a little bit with this sort of the expectation that we're going to see even more spending.
Yeah, yields are up a couple of basis points, 4.28% yesterday on the 10-year. Today it's 4.3%. Woo, big fear, especially compared to what's going on in French bond markets. Right. We talk a lot about Biden this morning. We didn't talk about Trump. We didn't talk about the fact that it was really the focus on Biden, but it wasn't, though, Trump really presenting this stellar performance. I am wondering about what this does to embolden him with respect to his choices for vice president, whether he leans more to a populist rather than a centrist, whether he feels like he has more of a mandate to cater more to the fringes in a way, because there is a sort of a vacuum on the other side of the ticket.
Yeah, I think it's a great point. If Joe Biden did not meet the very low expectations that were established for him, I think arguably President Trump did outperform expectations. He was more disciplined than certainly he was in those first debates in 2020. He was more moderated. I actually think the format probably helped him, the fact that the mics were being muted. But I do think your point about vice president, it puts us in sharper focus now because folks are now, because of concerns around Biden's age, are going to make this much more of a referendum on the vice president than even it was before. And as a result, who Trump's vice president is going to be is probably even more important as well, because that debate that is likely to happen either at the end of July or August is going to be, again, more important. So I do think that this was a win for President Trump. As we all know, debates are more performative. They're more about sort of performance than they are about style. And I think on style, he definitely won.
All right. So you also said that the fiscal is coming into focus. And I want to get a sense from you, given what we didn't hear yesterday, which is any discussion about taming this. How long can the United States remain, as John has mentioned many times before, in this place of being able to have the privilege of acting recklessly? How long before the U.S. starts to feel the same pressure that France does?
Yeah, I think that is the big question for sure. Again, we've talked about this many times, that you can't replace something with nothing. And the fact that the U.S. is the reserve currency, the fact that the Treasury is the reserve asset of the world, the fact that central banks still hold treasuries, that the fact that they still have this flight to quality characteristics. All of this just sort of speaks to the fact that this privilege is still extended to the United States. And what we do expect, though, and what we're telling our clients is that while we're not expecting the bond vigilantes necessarily to come back and to sort of enforce, spending restraints on Washington anytime soon. We would expect that there would be some term premium that would increase at the long end of the curve, right? So right now, the curve has been flat, inverted for the last 2 years. You haven't, as an investor, been getting that premium to hold longer dated paper with deficits. And I think this is interesting. This didn't really come up last night, but the CBO last week upgraded their deficit projections for the United States, and that they're numbers that are just really, pretty surprising. They're 6%, 7%, 8%. You add back the cost of the Trump tax cuts if and when they get extended, and then you're talking about 8% deficits. And yet the markets don't really move. So we are expecting the markets to sort of internalize this at some point and be reflected again in increasing term premium at the long end of the curve. But in terms of the reserve currency status, the reserve asset status, that does not seem like it's going away because, as we've been mentioning, look at the other developed countries. Look at the alternatives, right? As we've talked about a lot, Bill Gross's, assertion about the cleanest dirty shirt. The U.S. is the cleanest dirty shirt. It's not clean, but it's a lot less dirty than a lot of the other alternatives are.
The best thing about treasuries this morning, they're not French bonds. That's kind of it, right? But what Libby said, I think, is absolutely vital. Deutsche Bank had talked about this as well. The extent to which America is going to go on to pursue a very aggressive protectionist trade policy is something you have to take much more seriously this morning, based after what we saw last night.
Even an independent government agency, as Libby was talking about, is ringing the alarm bells and saying that we're going to see deficits unlike what we have ever seen in our history, that is akin to more of an emerging market. And nobody's really noticing it, saying we'll be able to work it out. When do they start to notice?
Libby, thank you. It's good to see you. Thank you. A focus on the process. Libby Cantrill of Pimco. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. A check on Nike this morning, down 14.5%. Its full-year outlook fell short of expectations. The company said that revenue would decline in the mid-single digits this fiscal year. The company's been struggling to churn out lifestyle wear with little offerings to replace their previous top sellers like Air Force Ones and Dunks. Instead, rivals have picked up the slack, like Adidas, whose retro Samba sneaker are fueling a new era of growth. The judge who scrapped Elon Musk's $56 billion Tesla pay package will hold a hearing on whether a recent shareholder vote to revive the deal should affect her decision. The Delaware Chancery Court may take judicial notice of the vote, but it's not obligated to recognize the results. Tesla has argued that the vote addresses many of the concerns that the judge raised in her decision. Boeing getting yet another round of criticism, this time from the National Transportation Safety Board. The NTSB said that Boeing provided, quote, misleading and inaccurate information to the public in a media briefing this week, that briefing surrounding their 737 MAX incident in January. In a letter sent to CEO Dave Calhoun, the regulator said that Boeing blatantly violated the agency's rules about active investigations. The NTSB said that it would therefore revoke Boeing's access to investigative information as the probe continues. And that's your Bloomberg brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, heading for 3 straight quarters of gains.
For the most part, we have been concerned about valuation on the one hand, yet have been, I would say, among the largest proponents of the game-changing nature of AI for well over a year.
That conversation just around the corner, live from New York City this morning. Good morning. Stocks positive here by a third of 1% on the S&P 500. In the bond market, yields a little bit higher by a single basis point. The 10-year 4.3020. As we close out the month of June, where did that go? Under surveillance this morning, heading for 3 straight quarters of gains.
For the most part, we have been concerned about valuation on the one hand, yet have been, I would say, among the largest proponents of the game-changing nature of AI for well over a year. When you go back and you look at similar high-priced valuation regimes, valuation alone is not a reason to sell stocks.
It's the latest. Tech and communication services leading stocks higher. The S&P 500 on track to wrap up the first half of the year with 4 straight weeks of gains. Bob Dole of Crossmark writing this. Equity leadership remains uncomfortably narrow and focused on secular growth plays. The key equity theme of late is to chase perceived secular growth plays regardless of valuations rather than position for a rotation into better valued laggards. Bob joins us now for more. Bob, you heard the words of Julian and Emanuel a little bit earlier this morning. Julian's talking about 6K on the S&P year-end this year. What's your response to a call like that?
Yeah, it would not surprise me. The mid-fives have surprised me as well. Valuation is an issue, but as Julian said, it is not a timing tool. All it tells you is the risk-reward should something fundamentally go wrong. And there we have to focus on the slowing economy and what the Fed might do as a result of that. You're seeing economic concerns, retail sales disappointed, the City U.S. Surprise Index coming the wrong direction. Signs that the economy is slowing, and that would surprise a lot of people who are expecting earnings growth double digits this year and double digits next year.
We saw that with continuing claims yesterday, Bob, when that data dropped at 8:30 Eastern yesterday morning. I'd ask this of you. The economy's slowing. We're losing momentum quite clearly. Inflation's come down a little bit as well. Unemployment started to climb. And I want to focus on the labour market, Bob. For the people that are hoping that we stabilise, plateau at these kind of levels, what would you say back to them?
That would be the first time in history. Things don't stabilize somewhere. They're moving one direction or the other. When it comes to employment, which is a key one because it's hung in there so well, underneath the surface, whether it's the work week, whether it's jobs available, et cetera, all of those are weakening as well. We just haven't seen it at the headline payroll numbers yet, and I emphasize yet.
I guess when you talk about the potential for some sort of downdraft at a time where momentum can also keep climbing, how do you hedge? How do you hedge downturn at a time where we were just talking about deficits in the United States, when we're talking about the potential for the Fed to really confront both an increasing deficit but also protracted entrenched inflation? Bob, do you basically barbell it, or is the barbell basically gold and then NVIDIA?
Yeah, I think you have to play the game. A momentum market is not one to stand in front of. It's like standing in front of a freight train. You don't know when momentum's going to end. There are no good predictors there. So you be careful what you own. You own companies that you have high confidence in their earnings predictability, earnings persistence, good cash flow stories. There are plenty of them. Those stocks have done fine on the upside, but should we get any kind of setback, I think those stocks will go down less. That's how you play the game.
Your conclusion is that risk on will persist. Bob, I have to ask, given the performance we saw last night by the sitting president, do you ignore what is happening in Washington?
Well, I have to take market cues. Markets tend not to pay attention to elections till after Labor Day. You get the conventions, the running mates, come back from the beach, and after Labor Day, now let's focus on the election 2 months from now. This is so unusual with this debate so much up front. I think the market, with the futures shrugging, it doesn't make a whole lot of difference yet. And look, but both guys are not spring chickens. I wish I heard last night a lot more about what they're going to do in the next 4 years. It was all about, you're a sucker. No, you're the worst president in history. Let's talk about the future, not the past.
And some questions about just how low that golf handicap actually is. Bob, let's have that serious conversation. 6, I mean, it's a stretch. When he said 6, okay, let's leave that there. Yeah, it's a stretch.
I've seen your swing, and you're not a 6.
I thought the same thing. But let's leave that there. Bob, I want to talk about the market. Where do you think in financial markets you would look to begin to focus on the prospect of a second term for Donald Trump? A much more aggressive trade policy, what that would mean for, say, foreign exchange, the US dollar, the prospect of extending the tax cuts from 2017, what that would mean for fixed income. When would you begin to start to focus on that a little bit more?
I think we have to do our homework now. I think the market will focus on it to repeat after Labor Day. I'm glad you folks talked about this in the earlier segment, but it's pretty clear if it is Trump, we're going to have a hawkish foreign policy, a more protectionist, if it's a Republican sweep, which it very well could be, the extension of the Trump tax cuts, All of that is interest rate upward mobility, and I think we will see some of that. On the other hand, if we get more of this economic slowdown, that at least for a brief time could work in the other direction.
You know a 20 handicap when you see one, don't you, Bob? It's got to catch up. Bob Dole at Crossmark. Bob, thank you. Bramo, these are things we have to take seriously, and sure, you can make the point that it's important, the makeup of Congress, what all that means for fiscal policy. When it comes to trade, that stuff doesn't matter. That's something we can talk about right now.
Especially given the fact that there are some similarities between both presidential candidates. I just think about how the risks are so bifurcated. It's sort of one asset class could do either really well or really poorly, depending on who wins and what their policies are.
Coming up on the program, we'll continue this conversation. We'll catch up with the former World Bank President David Malpass on a potential second term for Donald Trump. That's next. Stocks positive, up a third of 1% on the S&P. On the Nasdaq, closing out the month of June. Second quarter, the first half, we're positive by 0.4%. Even the Russell's having a look. We're up by 0.8%. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 10-year up by a basis point to 4.30. The 2-year at 4.7182. I have to say, Lisa, the Fed talk's gone a bit quiet. It's gone quiet, hasn't it?
Well, we get a number of people who are going to speak today. We've got Mary Daly, Michelle Bowman. We've got others who are going to be speaking. That said, in terms of the message, it hasn't been market moving. It is fascinating to me how stable yields have been over the past couple of weeks. We were talking about 20 basis point swings. We're not doing that anymore, and I think that that is a notable shift.
Let's talk about stability. Can we find some? Dollar yen, switch up the board, 160.62. The high of the session, 161.27. You know, Lisa, you nailed it yesterday. We talked about this a few times, the concerns about 140, 150. Don't go there. 155. Oh, no. 160, 161. When's it going to stop?
You know, honestly, full disclosure, one of my progeny went on a trip to Japan, and I had to transfer some currency into yen.
And you were happy about it?
And I was waiting as long as I could because I was thinking maybe it would weaken more. But you just wonder, you know, it's just moving quickly, and you wonder what's going to stop it, given the fact that you do have inflation, but you also have growth that's slowing in the region. So at what point do they bite the bullet and raise rates as soon as next month? This, to me, is really going to be an increasing kind of drumbeat heading into the Bank of Japan.
The rhetoric's still the same from the finance ministry. Rapid moves, one-sided moves. What we're all waiting to hear from the Bank of Japan, the central bank, is let's have a serious conversation about rate hikes. And I think that's what's really getting to what's happening in the FX market right now. It's just the same words, the same language, the threat of intervention, verbal intervention at the moment. The game changer is going to be when the BOJ actually starts having a serious conversation about hiking interest rates.
There have been a number of people who've come on this show and say, even when you look at the trade balances in the different economies, 160 seems like it's particularly weak for the yen versus the dollar. This is ultimately game theory, and this is a market betting that they cannot win unless they really shift policy on the monetary front, and they are betting that they will not do that, which is the reason why traders are shorting yen. At what point can they fly in the face of that and the Bank of Japan come out and say, we're going. We hear you, and we're not going to have it and go anymore.
Just want to know, because inquiring minds will inquire. Did you buy the yen? Have you done that?
Yeah, well, I mean,
that's taken place.
He's going. So.
Okay, great. So you did this at 160.
That's correct.
Quite a trade. Nice.
Thanks.
Well done. Congrats. All right. Under surveillance this morning, the U.S. military is moving assets closer to Israel and Lebanon as the risk for a full-blown war with Hezbollah grows. NBC News reporting forces are also preparing for the possible evacuation of U.S. citizens in Lebanon. This is the fear we've had for a number of months, the prospect that this war would spread across the region and include more bad actors, including Hezbollah. And this was a conversation we had yesterday with Amos Hochstein, advisor to the president.
Absolutely. And you can see what the U.S. is doing in making these moves. They're trying to set a different level of deterrence right now. What struck me is that they're talking to allies and planning, which is positive, but also how dire a situation that they're thinking that they need to evacuate American citizens. That would not look good on this administration, given the fact that they've had to evacuate American citizens for other instances as well, notably in Afghanistan. But really, for me, the marker was earlier this week. Lloyd Austin, the defense secretary, said exactly this. He said such a conflict could, quote, easily become a regional war with terrible consequences for the Middle East.
It just feels like there's a lot going on that we don't have visibility into, that in terms of negotiating and trying to quiet some of the tensions. Honestly, if this would become a conflagration that did engulf a broader swath of the region, you would expect a bigger market reaction. Right now, the market is expecting it to die down, regardless of the rhetoric and the bombs being shot and the fact that people have been displaced.
Yeah, Mohamed El-Erian talked about this, I think, in an FT piece a number of months ago, that the situation over there was kind of like boiling the frog. That people are just sort of ignoring it. You don't see much price action in the commodity market. You get that spread of that tension beyond the Gaza Strip to the northern frontier of Israel, involving things like Hezbollah, groups like Hezbollah, the risk that Iran gets involved directly as well. You can see how this can spiral in the wrong direction pretty quickly.
People talk about a significant risk premium that is not being baked in. I mean, this is not a small risk, and it only takes, one errant bomb to sort of create a real big problem. Right now, there's sort of a very careful calibration of not going ahead of their skis with every single sort of lobbed missile. When does that shift? The U.S. is having a big presence there, as Anne-Marie mentioned, to make sure it doesn't really escalate.
That's the latest in the Middle East. This is the latest in France going into the weekend. Marine Le Pen's national rally continues to gain ground ahead of the French election on Sunday. Bloomberg's poll seeing the party rise to 36.2%. A leftist alliance called the New Popular Front is second at 28.3%. President Macron's centrist group is trailing at 20.4%. And you push all of that through the bond market, and you've got higher French bond yields and wider spreads relative to Germany. The wider the year, we are in the 80s now. We have said goodbye to the 70s.
It's the widest spread going back to 2012, the highest yields on French 10-year bonds, 3.3%, going back to November at a time where people are looking at a France that has already been downgraded by the credit rating agencies and still is expecting to have more spending. It just goes to this question of the populist wave and what the ramifications are going to be for the markets, given the fact that everywhere other than the U.S. has seen some real moves as a result.
Well, let's talk about the United States and the main story front and center here. President Joe Biden and former President Donald Trump attacking each other on a range of issues, including on inflation and the economy. The former World Bank President David Malpass writing this in the Wall Street Journal. Mr. Biden has blamed everything except the actual cause. Expensive regulations and massive government spending. Donald Trump's approach to inflation should be he returned to office is likely to be different. Let markets produce more so that growth goes up and prices go down. David joins us now for more. David, wonderful to get your perspective on the programme, sir. I'm sure you've read the letter that came from the 16 Nobel laureates earlier in the week, warning about the risks associated with the Trump presidency and how it would reignite inflation. What would you say back to that this morning?
That Trump was pretty clear on how you could get more growth, and that's going to have a big impact on whether you have inflation. I think, I don't want to say PhD economists are off base, but that the group really has a model that hasn't been working. Think of all the huge mistakes that have been made on inflation forecasts in the past. So what we know is that Trump articulated this plan where you have more energy that holds down prices, that allows interest rate cuts, and you have more growth within the economy. He was really clear on how do you get jobs for minorities. You cut off illegal immigration and you have more growth in the economy. I was surprised by the contrast with Biden, who was talking, it seemed like almost as a senator, talking about Pell Grants, talking about first-time homebuyer credits, the small things that aren't really getting to the core of the affordability crisis that we're in right now.
David, let's just go through some of the policies. Extending the 2017 tax cuts, potentially implementing a flat tariff. You've heard those same economists talk about why that would lead to higher inflation. On those two specific issues, why wouldn't they contribute to higher prices?
Yeah, I think if you raise taxes, you're going to get less production, and that actually will be inflationary. And Biden is proposing big tax increases, and that's factored into the growth forecasts that CBO put out. The deficit forecasts that they're projecting under Biden are dependent on the idea that the economy will stay slow growing into the future. Trump is really going the opposite way and saying, no, that's not the economy that we want. We want a better economy that would generate more tax revenues and also more prosperity for people.
David, this is something that we've just discussed before, and it's a controversial point, the idea that you can grow your way into the deficit by cutting taxes versus having to raise revenues. I don't want to have that debate right now. I do want to talk about the idea of tariffs and what that does going forward, which is something that Donald Trump could unilaterally do. Do you believe in your core that if the former president does become elected and does engage with pretty significant tariffs across the board, which he can do unilaterally, that if the market sells off, he would reverse course?
we've seen Biden continue the tariffs that were on China, and the market is able to digest a whole lot of things, as it's doing this morning. So I think the market adjusts to the policies, and the overall question is the U.S. going to be a strong player on the international scene? Trump talked, I thought, very effectively last night about Afghanistan and the disaster that created, and it's spilling over to all the other world situations. So you can create a better world by having an actual plan that's based on production. And so you're saying, what about tariffs? Well, there's a whole plan, or there are lots of things that can be done in the U.S. to really allow this strong economy to move forward.
Well, but David, just to sort of pick up on the tariff point and sort of what I was getting at, there is a belief in markets that potentially the former president would reverse course on tariffs that were highly negative for the market. A lot of people have come on the show and said a lot of the tariffs that have been proposed would increase inflation in this country and would actually create a real negative situation for a number of companies. Do you believe that if the market does sell off, that would provide a check to the former president and that he would reverse course?
Well, that's a real hypothetical. So really, I think what we have to do is over the next 5 months survive and then see how do you resolve some of the wars meaning resolve them quickly and allow energy production to start. And then as you look at tariffs, I think there needs to be a real rethink of how do we interact with China, who has been this giant overproducer or, very successful industrial producer that takes away jobs from the rest of the world. There needs to be a world discussion of that. You're seeing the politics in Europe, you were just referring to it, of people in Europe realizing that this cost on climate is really hurting their competitiveness. So Germany's economy is in deep trouble, in part because energy costs are so high. So that drives people to other answers to try to deal with and interact with China into the future. I think that'll be an important part of a new administration.
David, let's go where you almost went, though. What is the plan on tariffs? Are these just talking points right now, or is this a plan, if we were to get Trump to be president again, that is going to be 10% tariff wall for all imported goods and 50 plus on Chinese imported goods?
You have to have a room with people in it, with lawyers in it, with what is the legislative process with it. So I think there will be a very detailed discussion of how do we protect, how do we have sectors in the U.S. that are able to stand up to subsidized production from abroad. And that's a valid discussion to have, should have been happening already, and needs to be done more deeply.
We had on Maya McGinnis today from the Committee for a Responsible Federal Budget. I'm sure you know her well. And they put out some numbers this week about how President Trump approved $8.4 trillion of new 10-year borrowing during his full term. And Biden, during his first 3 years and 5 months, approved $4.3 trillion of new 10-year borrowing. Do you honestly think either of these individuals are not going to add a substantial amount of money to the deficit?
To the deficit. Let's talk about debt and deficit. If you have a faster growing economy, you won't have as big a deficit as Biden is projected to have. CBO is operating from the economic plan that's in place now, which is one where, and you heard it all last night in great detail, the government is going to be the solution for each thing, and interest rates are going to stay high for a long time because of the inflation. So if you project that out, you're going to get huge deficits into the future, which is what shows up in the CBO forecast. If you redo the forecast based on a growth program, you don't get those deficits. Now, I think there also has to be very strong restraint on spending. Washington is spending like crazy, and it's out into the future. It's every month. It's trillions of dollars going out the door. President Trump talked about the Paris Agreement costing $1 trillion. I think he's understating it. It's worse than that. So on the energy front alone, the subsidies and credits that are being put out on that side are super expensive. Some of that can be saved still, and the market will react positively if you say anything that causes them to think you're going to have some restraint. Right now, they're operating on the idea of no restraint, and that keeps interest rates high.
David, you're close to the campaign. It's all quiet on the VP front. Who should we be focused on, do you think?
No, I don't have that's up to President Trump. And I think what you saw last night is somebody that's going to make a lot of decisions on things. He landed a lot of blows, and one of them was that Biden hasn't fired anyone. This is a really important part of management and of governing, of choosing people, and Trump will have the chance to have really strong people in across the board, and I think that can really help. There just hasn't been enough strength within the U.S. administration that's operating now, and you see it in every policy meeting that I was in. You see it in the results that came out of those programs. It's not working, and so we need change.
David, it's great to catch up, sir, as always. I know we'll continue this conversation over the next 4 months or so. David Malpass, the former World Bank president, and maybe the future something in the next administration.
It sounds like definitely potential something in the next administration. You just wonder, this is sort of a key debate, and this is something David talked about, the idea of growing your way into growth. It sort of hinges on the whole idea of the trickle-down voodoo economics of the Reagan time versus something else. And the combination with the cuts, where would those cuts come from, right? And that's a key question. These are real questions that we can keep having into the debate.
Much more important questions, particularly after what took place yesterday evening. Let's get you an update on stories elsewhere this morning. We can do that with Danny Berger, as always, with your Bloomberg Brief. Hey, Danny.
Hey, John. Richmond Fed President Thomas Barkin said that the inflation battle still hasn't been won and that the U.S. economy will remain resilient as long as unemployment remains low and assets high. He is speaking at a conference in Paris, and Barkin said that the lagged effects from rate hikes are still playing out and that they will eventually slow the economy. Investors have a key read on the U.S. economy at 8:30 a.m. when PCE deflator hits the tape. Apple is reportedly exploring new options that would allow iPhone batteries to be more easily replaced by customers. The update follows a law passed by the EU last year that aims to protect consumers. According to the site The Information, at least one model of the iPhone 16 and potentially all iPhone 17s may get the new battery option. An Apple spokesperson declined to comment on the story. The NFL is facing a massive antitrust lawsuit after a jury sided with fans over pricey broadcast subscription costs. The league was hit with a $4.7 billion damage, which stands to be tripled to $14 billion under federal law. Fans had claimed that the league conspired with DirecTV to raise the prices to watch out-of-market games. The league made the unusual decision to take the suit to trial, with Commissioner Roger Goodell appearing as a witness. A league spokesperson called the verdict disappointing and said the NFL plans to appeal. And that's your Bloomberg Brief, John.
Danny, thank you. Up next on the program, the data-dependent Fed.
Generally speaking, the trend in inflation is lower. Core PCE inflation is likely to be around 2.5% in May. I think they could probably be talked into a cut in September.
Was there a natural argument between you and Neil?
No, he just thought, AMH is nodding.
Yes.
No, he called me out for cherry picking, and I said, everyone's cherry picking. And he said, you look at two data points, it's unemployment and inflation. That's it, period, full stop.
It got intense when he just looked down the barrel of the Zoom camera and said, Lisa, there's only two data points that matter.
Neil got intense. You should have seen Lisa's face. Off camera, that's always the money face. That one right there.
We need a
I've said we need a Bramo cam for a long time.
I would act different.
Said it for a long time. From a beautiful New York, this is Bloomberg. Equities are positive, treasuries a little bit lower, yields up, single basis point, call it 2 basis points higher on a 10-year right now, 430.39. In the equity market, positive by about 1/3%. Under surveillance this morning, the data-dependent Fed.
Generally speaking, the trend in inflation is lower. Core PCE inflation is likely to be around 2.5% in May. Let's focus on what's in the summary of economic projections. That's ultimately how you back out the Fed's reaction function. In that in those projections are unemployment, core inflation. I think they could probably be talked into a cut in September.
So here's the latest. Futures gaining as focus turns from the debate to the data. The May PCE deflator due out in just over 30 minutes' time. Investors hoping it will solidify the case for a rate cut this year. Michael Kushma of Morgan Stanley writing this. The Fed is keen on a soft landing, but the big question is, have high interest rates done all they can do without creating too much pain? Michael joins us now for more. So Michael, right on cue, we've just heard from Mr. Barkin of the Richmond Fed, and he said the US economy is withstanding the Fed's battle on inflation. Neil Dutter, we just played some sound from him, he wrote in this morning and he said the economy, consumer, retail sales and food services are flat for 5 months. On housing, pending home sales are at fresh lows. New home sales are the lowest since November. CapEx, core capital goods orders and shipments are flat for 6 months. He says that Barkin's language is totally detached from reality. Michael, can we get your assessment on how detached from reality those comments are?
Well, I think it's your definition of reality. If you look at goods price inflation is close to back to zero. So that's worked. Interest rate sensitive sectors are struggling. Generally speaking, housing, construction, all those areas. So interest rates have done their job. They've brought demand and output down from the peaks we saw over the last couple of years. The areas where inflation has remained high, core services, is somewhat immune to higher interest rates, except to the indirect effect of lower incomes, people spending less money. I'm sure you've been traveled recently. I've been traveling recently, and every plane is full. Business class, economy, everything. Can't change seats, can't change planes. So a lot of core services are still quite strong, and that spending is more a function of wealth than just worries about income, which is strong for most people. So I think it's the question for the Fed is that will keeping high rates high do the job of bringing inflation down sooner without causing too much damage in the interest rate sensitive sectors. And the problem there is that wealth creation still is rolling along. That household wealth is at record highs. So why is that going to slow down spending unless the unemployment rate drifts higher for the higher income people, 25 through 54-year-olds?
Michael, we have been talking all morning about politics, about long-term trends of deficits and potentially tariffs. We are 40 minutes away from what we've been building up to all week long, which is core PCE deflator, the key inflation metric, and personal income and personal spending. Which of these data points is going to be really important for you when you think about where rates should be, the Fed response mechanism, and where really we should be focusing?
Core PC is the Fed's preferred target. It is the most important number. There's a big gap between core CPI and core PCE. Core CPI went up a lot more than core PCE. It's come down faster. The question is that gap going to close by core CPI coming down to core PCE? Is core PCE actually too low relative to core CPI? And that's going to drift higher over time, not higher, but higher relative to core CPI. So we see fewer improvement in core PCE. Core PCE tends to be stickier. I think that the numbers is coming down. The year-on-year numbers have been improving, but the year-on-year comparisons to last late summer, fall is going to be difficult to improve upon, considering how surprisingly low inflation was in the second half of this last third of last year. So core PC is likely to keep coming down, but the gains are likely to get fewer and fewer over time. Then the question the Fed has to say is core CPI continuing to fall can put downward pressure, more pressure on core PC over the next couple of months. But I don't think core PC is a constraint on the Fed for cutting rates. It's more about the strength of the economy, and the unemployment rate is still pretty low.
Which goes to the personal income level and what we see there as well. I am wondering, we had been seeing huge swings in bond yields over the past few weeks. It had been pretty wild in the day-to-day moves. It's been pretty stable over the past couple of weeks. Do you expect that to continue, regardless of any surprise? Core PC probably baked in, because people can already calculate that by backing out certain data points. But do you expect this kind of stability to continue?
It's going to be, I think, a little bit challenging. The market thinks, 2 Fed rate cuts this year. The Fed says 1. Both are they're reasonable. Both forecasts. It could easily be 1 or the other. It could be 0. Not likely to be 3. So the question for bond yields, 10-year Treasury around 4.3%. That's pretty low. With the Fed funds at 5.5, that's a huge inversion of the yield curve. I think it's difficult to get 10-year bond yields lower unless the past path of rate cuts is accelerated. And I think that is still a challenge. So I don't think there's a reason to sell off a lot. I think we are stuck at these levels waiting for a surprise, a good surprise or a bad surprise on the inflation number. A good surprise could accelerate the path of rate cuts, bringing down 10-year yields closer to 4%. If inflation remains stickier, or worse, it goes up relative to recent numbers, then 10-year bond yields probably going back to 4.5%. But the point is, volatility is likely to stay relatively muted in this 4.2, 4.5% range.
Michael Kushma, thank you, sir, of Morgan Stanley. You mentioned the inverted yield curve. The yield curve, let's take the 2-year versus the 10-year, has been inverted now for so long that many people have just stopped talking about it. What's the significance of it, Lisa, when you think about that inversion? And we've been inverted, I think, for a number of years now. Is it 2?
It's in the longest period ever in history, and typically in the past, an inversion indicates some sort of recession at some point. People are saying maybe we've already had one, and it just sort of was too light and covered up by NVIDIA, so it didn't even make a dent. I don't know what to make of that, but I think Michael Kushma's point is really interesting. We are stuck at these levels waiting for a surprise because unless you get material rate cuts, it is hard to see the 10-year yield materially moving lower and inverting the curve even that much more.
2-year versus 10-year, negative 42 basis points. The third hour of Bloomberg Surveillance just around the corner. Here's the lineup for you. Elizanne Sonders of Charles Schwab, Aneesha Sherman of Bernstein, Mohamed El-Erian of Queen's College, Cambridge, and we'll speak to Torsten Slok of Apollo from New York City. Futures are positive by a third of 1%. That's your good news. All the bad news for a certain president is down in Washington, D.C. This is Bloomberg.
Generally speaking, the trend in inflation is lower.
I really don't think inflation is going to pick back up. I think that it's slowing. It's going to keep slowing.
Markets, trying to figure out what the Fed's going to do next, and it's pretty difficult because it's very much data dependent.
There's a lot of data between now and September. If we see inflation coming down, if we see the labor market continue to cool, they're going to go in September.
We think things should slow down. We think inflation's coming down as well, and taken together, that allows the Fed to cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. 1 hour of this program left. We'll do something a little bit different. No politics for the next 60 minutes. The focus will be on the economic data. PCE, 30 minutes away. Just got a note from Citi's Andrew Holdenhorst. The slowdown sets in. This is what he has to say. Downward revisions to consumer spending, rising jobless claims, soft durable orders, and weak housing data out yesterday, in his opinion, further establish a broad-based economic slowdown. This hour is all about the data.
He is not alone, and a lot of people had been talking about this over the past few weeks, that the data has been surprising to the downside more and more frequently. Here's the question. Everyone's talking about core PCE. I want to know whether income still is expected to outstrip spending, or whether we see basically the personal deficits of individuals getting deeper.
I know you don't want to talk about the politics, but policy is important today still. Trump yesterday did bring up tariffs, as did Biden. Biden went after him and said they're going to be inflationary. And that's what these 16 economists that came out and wrote this letter about. Policies like that. If you get PCE now to the slowest level we've seen in months, slowest level this year, that will be a huge win for this economy. Yet the concern is what's on the horizon for 2025.
The focus on inflation is just increasingly feeling a little bit stale given what's developing in the labour market. That can change again. But ultimately, for me, that's where things stand at the moment. If you look at jobless claims, and this was from B. Mosey and Lincoln just yesterday, initial claims dropped 6K, but the prior week was revised higher to 239, making it the highest claims print for a non-farm payroll survey week since June 2023. Are we going to plateau at these elevated levels? Will we break down to the low 200K again? Or are we going to start to incrementally start to break out? And that's the concern that lots of people have.
Especially because of the differential between the payrolls and the household survey and employment and how different it has been. There have been a lot of people who say never in history has it been a linear move where you just see unemployment tick up in a sort of gradual way. And so this raises this question, how different is this moment at a time where people are saying it is still distorted from post-pandemic realities that are very different than what we've had before? That is what is addressing people, and the reason why today's print might not move the needle when it comes to the narrative, but it's another data point on that march.
The payrolls report about a week away. That's going to be a big one, particularly after what we saw, the divergence between The last report, and to your point, establishment versus household. Equities right now on the S&P 500 going into that opening bell are positive by about 1/3 of 1% on the S&P. We'll have a big conversation about Nike a little bit later. In the pre-market, that stock is lower by anywhere between 13 to 15%. That stock, Lisa, is getting absolutely hammered this morning.
At a time when you're wondering, how do you remain relevant in a world that's shifting very quickly? We talked about the running cohort and the whole idea of Hoka and On and what happens with that. It really raises this issue. Even people would say, oh, it's China and it's the China sales. No, the China sales actually outperformed. It is Converse sales down 18%. Even their benchmark sort of Air Jordans not delivering. And it raises this question of relevancy at a time when this is a fast-moving retail and consumer market.
That stock getting hammered. Coming up this hour, we'll catch up with Sonders of Charles Schwab as the second quarter winds down. We'll catch up with Bernstein's Aneesha Sherman as Nike stumbles on a weak earnings report. And we'll speak to Mohamed El-Erian of Queen's College, Cambridge, reacting to PCE inflation data dropping in about 26 minutes' time. We begin with the big issue, wrapping up Q2. Sonders of Charles Schwab saying this: we do see building risk of some consolidation at the index level if performance divergences persist into the second half of the year. While they don't seem imminently fatal to the bull market, we think more members will need to start joining the party for the music to stay on. Lizanne, I'm pleased to say, is with us now. Lizanne, I was going through some of the stats in your work. Only 17% of the S&P has outperformed the index over the last year. You pointed out the NASDAQ, that number is much worse at 11%. Can you just build that out for all of us? What do you think that indicates?
Well, I think it indicates that we really have two markets here at the index level and then under the surface. And you can see it via stats like that, percent of the index, whether it's S&P or NASDAQ outperforming. And that table that you pointed out, Jonathan, also shows 1 month, 2 month, 3 month. And you don't get much more than about 25%, no matter what time frame you're looking at. But another way to think about it is the average member maximum drawdown within these indexes. So we know the S&P is at an all-time high, NASDAQ at an all-time high. You've had no more than a 5% drawdown in the S&P, only 7% drawdown in the NASDAQ, but that's at the index level. In the case of the NASDAQ, the average member maximum drawdown just year to date is 39%. So there's a heck of a lot of turmoil and churn and rotations going on under the surface, which I do think reflects all of these uncertainties that we all talk about on a day-to-day basis. You just don't see it at the index level because of that mega cap bias.
Lizanne, some of these stats you just shared with us, are they a typical feature of a typical bull market, or is there something very unique and unusual about this experience?
So what's not unique is having a relatively small handful of names really drive performance via their size. It's when the rest of the market is significantly underperforming that's where you get into historically rare sets of circumstances, and also suggests that some consolidation is probably likely. And I think that shift could happen with convergence. And in fact, I think that might be a somewhat healthy thing if we saw further pullbacks in some of those mega cap names, but at the same time, more of a clawing higher on the part of the rest of the market. Interestingly, that was what was happening in October of 2022. The indexes were taking out their prior June lows, but under the surface, you were seeing improving breadth. You were seeing more of the kind of soldiers head toward the front line. And so even though at the index level it didn't look great, that was a sign of some grinding higher on the part of the names that were just not in focus in a cap-driven market.
This is fascinating to me, Lizanne. We had earlier Julian Emanuel of Evercore basically saying that the lack of breadth is a feature, not a bug, and that, frankly, the fact that you're seeing equities up on an index level without the participation of so many shares highlights the resilience of this market and the fact that it's been powered by these names and the others can really converge to the upside. What's your argument against that?
Well, no, I don't disagree with that. In fact, I think when going back to that negative 39% maximum drawdown at the member level for the NASDAQ, that kind of weakness under the surface breeds opportunity. So when you have that poor breadth, at some point, you start to see an improvement there. And I think that's where there are opportunities that are presenting themselves. The other interesting thing about this focus on the Magnificent Seven or the, Magnificent Six or Fab Five, whatever component you want to talk about of these mega cap names, is from a contribution to index return perspective, they're all in the, call it top 10, but they're not the best performers. from a price performance perspective, only one of the Magnificent Seven is in the top 10 best performers in the S&P 500. Look at the 10 best performers in the NASDAQ year to date. None of them are household names. None of them are in the Magnificent Seven. And so I think it shows that there's a lot of churn under the surface, but that has also bred opportunity, and that there are ways to find performance. And in this environment, we continue to say you want to stay up in quality. And that may seem like the ultimate, well, duh. But there are times where you want to go down the quality spectrum. That's where the leverage is for companies that have weaker balance sheets or have lost their earnings, have that leverage to a pickup in the cycle. I don't think we're at that point. So staying up in quality, if you look just at the performance spread between profitable within the Russell 2000 and non-profitable, it's about 14 percentage points, with strong double-digit positive gains for profitable and negative on the part of non-profitable. So there are opportunities that get born out of a tough breadth environment like this. And I think that gets lost in a lot of this analysis.
I love this, Lizanne. It's sort of like you scramble the macro narrative enough that you force people to actually pay attention to what individual companies are doing. Because for so many years, the macro narrative blinded everybody to some of the single name type of analysis. What happens when the macro is not scrambled? What happens when we have a direction? How much does the whole market become vulnerable in a new way because of how high the elevation has been for some of the valuations at the top?
Well, I think recession would certainly be a macro narrative that is not priced into the market broadly. There's certainly metrics that are pointing in that direction, but a heck of a lot of economists thought that last year, and that was not the case. And that's just the unique nature of this cycle. But I think more significant deterioration, particularly in the labor market, even if it provided the Fed the green light, start easing policy. I think any backdrop that requires the Fed to have to be quick and somewhat aggressive on the downside with rates. I always say to people who want the Fed to start ASAP and move quickly, be careful what you wish for, because one of the clear distinctions that's happened in the past with regard to Fed policy and impact on the equity market at the point where they start easing policy is slow versus fast. A slow-moving Fed in the cutting part of the cycle is beneficial for the equity market for somewhat obvious reasons, in that they're probably not combating a recession or a financial crisis or some combination thereof. A Fed that has to start moving aggressively on the downside so soon after such an aggressive move on the upside, I think that would be destabilizing for the market.
Lizanne, I'm so pleased you said that. Not all rate cuts are created equally. You're just dead on. Lizanne Sonders of Charles Schwab, one of the best, and great to catch up with you as always. Lizanne, thank you. Just want to turn to the market boards briefly and start with equities and look at equity futures. And I've got a question at the end for Lisa, not for me to answer. Equity futures right now on the S&P positive by 1/3 of 1%. Some outperformance on the Russell up by 0.8%. How many people this morning are looking at the charts from yesterday evening into this morning and looking at what futures have done and attributing it to what developed in that debate last night?
Nobody. Absolutely nobody, which I find interesting. There are no notes saying the market is rallying because the former President Trump has a likelihood of becoming president. Most people saying the markets are not responding. And the reason why is because it's too soon to understand the composition, and they don't pay attention until after Labor Day. When do we start attributing this to it? I actually thought about this morning. It just shows how kind of arbitrary it can be sometimes when we assign a narrative to a market move. Sometimes it's obvious, and sometimes it's really not.
People are calling this debate, though, a disaster for the sitting president of the United States, potentially because Democrats are out in the open now discussing for months what I've heard behind the scenes, which is maybe they could not have Biden be their candidate. The DNC is in August. Maybe that's why markets are actually not selling off. Maybe they think this could be a 1968 Lyndon Johnson moment. He makes a speech and he steps aside because his performance was so bad.
The opinion section of the New York Times, a lot of people are sharing this online at the moment. I can show you some of the headlines from it. Joe Biden is a good man, good president. He must bow out of the race. Biden cannot go on like this. After the debate, I don't think Joe Biden should be running. You see these kind of headlines repeatedly this morning.
At the same time, what we've heard is it doesn't seem like it's resonating inside the Biden camp. Let's see what happens. A lot of people saying it has to happen within the next 2 weeks. That's what Libby Cantrill said of Pimco, basically saying that is sort of the deadline, the drop-dead deadline before we can get potentially a new candidate at the top of the Democratic Party.
It's certainly going to be a long weekend for that campaign. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israel and Hezbollah are heading closer to a full-blown war in Lebanon. It's been a steady tit-for-tat between the two, and it started after Hamas attacked Israel on October 7th and has been shifting into something more alarming. Record numbers of Hezbollah projectiles have hit Israel, and Israel is carrying out deeper and more destructive attacks in Lebanon. Tens of thousands of residents have been driven from homes in both regions. A check on Apple shares this morning, up ever so slightly, less than 1%. iPhone shipments in China rose 40% in May after heavy discounts ahead of the country's June shopping festival. Shipments jumped 50% in April as Apple attempts to bounce back from weaker Chinese markets. Overall smartphone shipments, though, climbed more than 13%, but foreign brands grew almost 4 times faster. That's according to Bloomberg calculations of official data. Microsoft has told more customers that their emails may have been accessed by Russian hackers. In January, Microsoft had disclosed that senior leaders' emails were stolen, but now the company is acknowledging that the hack was more widespread. Microsoft has been dealing with strong condemnation by U.S. governments for security breaches, with the company now undergoing one of the biggest security overhauls in decades. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the morning calls on one stock. It's Nike. We'll catch up with Bernstein's Aneesha Sherman as Nike stumbles on a weak earnings report. That stock is down by 15% in pre-market trading. From New York, this is Bloomberg. The opening bout a little more than 1 hour away, with equity futures positive here by 0.4% on the S&P. Yields shifting a little bit higher by 2 basis points on a 10-year, 430.59. Time now for some morning calls with just one stock in focus. It's Nike. First up, Stifel downgrading the stock to hold. The analysts seeing limited upside due to the retailer's disappointing guidance. Next up, Morgan Stanley downgrading Nike to equal weight. The analyst expecting a volatile year ahead as the company undergoes strategic changes. You saw note after note this morning, finally including this one. Bernstein cutting its price target on Nike to 112. The analyst Aneesha Sherman saying investors should wait for more signs of innovation success before they put their full confidence behind the stock again. Aneesha's with us now for more. Aneesha, I've been looking forward to this conversation with you for a while. You've made this point repeatedly. I want to ask you the question that you've asked yourself, which is why are market leaders losing market share? What is Nike getting wrong?
Nike has done a poor job innovating for the last few years, and we haven't seen it very visibly in the market because the market was doing great. In 2022, people were out there revenge spending. Nike was excessively leaning on some of its older product lines, some of the more recent launches from several years ago. Now that the market is starting to pull back, people are starting to look for value. This is becoming obvious that they don't have a lot of new innovation out there. There's new competitors that are eating their lunch, and they need to do a hard reset and push new innovation out before they can start to gain share again.
Do you think they need to do a hard reset on certain business lines? Is it the more sort of lifestyle brands, the Air Jordans, or is it the sort of nuts and bolts, bread and butter of what this company is built on, running shoes? Is it both? Is it one or the other?
It's both, but the timing is different. So their biggest running franchise is Pegasus, and they've pretty much done the reset there. They just launched a new product. They are no longer selling or producing any of the older lines anymore, and they've got a lot of new launches coming in the next 6 to 12 months. So that reset is done, and we saw that in the results this quarter and the prior quarter where sales were hampered by that. They now need to do this reset on their other big franchises, on Jordan, on Air Force One, on Dunk. And this is a big part of the portfolio. So this is going to take a big toll on sales, particularly in the first half of their fiscal year, which is basically the back half of this calendar year.
Aneesha, a lot of people during the pandemic said that a lot of the shopping platforms were losing clout and the direct-to-consumer trend was increasing, that the likes of Nike could go on brand appeal to such a great degree that they could get people coming to their websites and shopping off there. That didn't seem to be the case in these particular earnings. Does that make you think maybe that trend has sort of peaked, or do you think that there is just simply a blip because Nike isn't cool anymore in the same kind of way as some people are saying?
Yeah, so the DTC trend, a lot of brands got carried away by this because, as you said, it worked really well in 2021 when everybody was shopping online and there's no transaction costs, there's no friction to shopping online. You can open any browser window you want and comparison shop. So why not just buy it from the brand? What they missed is they looked at e-commerce penetration rates in 2021 and they extrapolated from that point, which was a mistake because we all went back to stores when we could. And so now retail is much more important than it was in 2021. And by pulling out of a lot of retail, many brands have lost their place in that distribution and lost that market share. So they're now having to take a step back and regain that, including Nike.
We're talking about Nike right now. It's an $142 billion market cap company, which is a significant size. It's a daily move for NVIDIA. I'm looking right now at sort of the larger question, especially ahead of personal income and spending, which we get in just about 10 minutes' time. Is there a sense that Nike's pitfalls stem from a weakening and more selective consumer, or is this just a Nike problem?
I think it's a bit of both. So it's obviously a Nike problem in the sense that their new innovations have not been able to draw in as much demand and brand heat as they should have done. And now they're having to correct that by cutting some of the older franchises and reinvesting in new innovation. However, it's also in the context of macro. So this same issue didn't cause them problems in FY22 or 23, where their sales were growing, 16% in the last fiscal year before this one. So that was in the context of a macro where consumers, particularly middle and higher income consumers in the US, were in this wave of revenge spending. They had pandemic savings left over. They were going on trips. They were getting out there. And now their savings are run out. Their credit card debt is high. They're repaying student loans. Their wage growth has not kept up with inflation, and there's no revenge spending catalyst. So they are pulling back. And in the macro context of a pullback, you need to have something really new and different to draw in consumers.
So is this a win for Adidas and Lululemon? And I mentioned them because you specifically talk about them in your note.
I think they're all in different places. I think Lululemon is facing some of the same macro pressures on its consumer, which was also spending in 2022 and is now pulling back. And they need to also rethink their own innovation, particularly to attract younger consumers and to attract men, so kind of outside their core middle-aged women consumer. For Adidas, they're on the upswing. Their terrace trend is working. It's working globally. They're at the peak level of that trend. And the question is, can they sustain that trend? Can they do more to keep it going, or is it going to fade out next year? So they're in a good place right now. It's just a question of can they keep it?
When you talk about innovation, are you basically just saying they need to be cool again? Because our Bloomberg intelligence analyst basically said Nike has nothing new. There's no newness to this brand.
Yes, it's coolness, it's newness in design, it's, getting a silhouette out there that looks different, that looks exciting, that people want to buy. It's not necessarily about technical innovation. I mean, most people who run are not really concerned with what the carbon plate or the midsole foam composition is because they're not trying to shave 30 seconds off their marathon time. They want something that's comfortable and that looks good. So it's about design, innovation, and comfort rather than, real technical prowess, which Nike already does very well.
Aneesha, why haven't we seen more acquisitions? I can think of a brand like Athletic Propulsion Labs, which makes a very sleek shoe, really nice sneaker. I've had a couple of pairs over the last few years. I've always wondered why some of these big brands haven't come in and bought other brands like that. Why isn't that happening?
It's not a very acquisitive sector, and some of the acquisitions in recent years haven't gone very well. If you think about Lululemon buying Mirror or Adidas buying Reebok, some of the acquisitions have not been particularly successful. Most of the big brands believe that they have the in-house talent to create this design, and they already have the retailer relationships and the distribution footprint and the consumer awareness. So as long as they can do that design innovation in-house, that's a better way to do it. Now, it's contingent on them being able to innovate in-house, and that's the hiccup that Nike is facing right now.
That's certainly been the struggle. Aneesha, it's good to hear from you. Aneesha Sherman there of Bernstein, with that name down in the pre-market by 15%. Why are you both laughing at me?
Well, I immediately Google, of course, Athletic
Same.
Propulsion Labs, and I start looking and
APLs are
figuring
nice.
out which particular shoes you've had.
Is it the $320 version? Is it the $430 version? You're spending a lot of money on shoes.
I'll share them with you. It's a pastime of mine. I'm not a big drinker. I work out. I go to the gym.
Okay.
I need sneakers.
Do you do it for the technology and just the speed?
No,
and
I love
durability?
the look. I find them very sleek. They used to be distributed in Lululemon stores. Then that stopped and they went through their own channels, I guess. You can only buy them direct from, I believe, APL now.
That's Aneesha's point, is that basically people are going to buy it off the way they look and whether they're relatively comfortable. I will say some of the running shoes that I find the best personally are not particularly attractive, and I feel incredibly anxious about it
Like
every time.
Hoka's?
Well, I'm not going to get into the Hoka debate, but the ones that I have are in particular very functionally good, but, not the most beautiful.
You care about the carbon fiber plate and all of that stuff, right? Is that what you're saying?
It's on brand, don't worry.
Okay, all right. It sounds very on brand. All right, are you done taking digs?
Well, I was just going to say that
One
I think
more?
Nike missed
Okay.
one certain moment, which is actually, you see all these opinion pieces, even in the Wall Street Journal, about how athleisure wear has moved into workwear. And they could have had a moment here coming out of the pandemic with more people buying a lot of these goods and even using it if they're going to go back to the office 2 or 3 days a week. And they missed that boat.
That's something I have strong feelings about, that athleisure became workwear. But anyway, this is meant to be a
I do
serious
as well.
morning.
There should be work dress policy.
I agree. This is meant to be a serious morning. We'll be focusing on the economic data next. Breaking PCE data. Mohamed El-Erian of Queen's College, Cambridge, joining us in just a moment. And later, Apollo's Torsten Slok. All of that and more still to come as we count you down to the opening bell, about 1 hour and 4 minutes away, with equity futures positive by 0.4%. Where has June gone? Where has Q2 gone? Where has the first half of 2024 gone? It's all behind us now. One more day to go. That day is still ahead of us with equity futures positive. This is Bloomberg. Seconds away from economic data in the United States, I can tell you that Mohamed El-Erian is joining us in about 2 minutes' time. No tie. I'm not sure if that's an indicator of whether this is going to be hot data, cool data. We did this around the labour market, right?
When was the last time he wore a tie? We can ask him, and then we can really decide whether or not this is deliberate or
He
whether
joined
this
us
is a new
payrolls
trend.
Friday, did not have a tie, and the labour data came in hot. Remember?
There you go. All right, so maybe this
There
is
we
a
go.
sign.
We'll see. I've got no idea. Futures positive by 0.4% on the S&P, on the Nasdaq up by 0.5%. In the bond market, we look a little something like this. For Treasuries, the 2-year, 10-year and 30-year yields a little bit lower on a 2-year by a basis point at 469. Call it 470 as that data drops. Mike McKee's with us. Morning, Mike.
Good morning. I have a tie on, and I don't know what that means, but it does mean that consumers' income comes in higher than expected, up 0.5% compared with a 0.3 rise in the month of April. Personal spending 0.2, which is a little bit lower than the forecast, but same as last month. And then the numbers everybody cares about: PCE price index flat on the month as forecast, which means the price index goes to 2.6% from 2.7%. Core is up just 0.1 as forecast, and core PCE 2.6% on a year-over-year basis. Now, what this tells you is that economists are getting very good at forecasting PCE, and the Fed can continue to look forward to lowering rates without giving us a time frame to do so.
And no bad news here, Mike, and that's good news. So this rally this morning isn't disruptive. It continues. We are positive by 0.5% on the S&P. You've got the small caps, the Russell up by more than 0.9% now, just pulling back a little bit from those levels. In the bond market, yields were a little bit higher. Now they're a little bit lower, particularly at the front end on a 2-year by a basis point or two. We break 470 to the downside. In the FX market, Japan is grateful, I guess, 160.54 on dollar yen. Lisa, on that currency pair, we're negative by 0.1%.
You know, you said something a while ago that no surprise is basically a good surprise, at least for the bond market, and that's what you're seeing today. The one thing that might be somewhat unexpected is that personal income exceeded personal spending by such a big degree. That's going to be an increasing question. Does this mean that the consumer is actually, A, being a little bit more disciplined, and B, actually seeing their personal finances get better, not worse?
Mike nailed it, I think. With PCE, it's easy to predict once you've got CPI Micah, once you've got PPI, you've got all the details you need and you can come up with a decent estimate. We've now got jobless claims behind us, continuing claims behind us, going into payrolls next Friday. Have we got a decent picture of what happened in the survey week and how this might come out the other side for payrolls next Friday?
Yes, but you can't really use jobless claims the same way you can use the CPI for PCE. It suggests, the jobless claims side suggests that there's not been a lot of change in the overall labor market. And so if you think that we're still adding workers at a reasonably strong pace, then you can go ahead and extrapolate that out. Now, one of the things that we end up doing is taking the ISM hiring plans numbers, to a certain extent, ADP. We won't get into that, Lisa. But you take all these other indicators and you try to plug them in and come up with something. And right now, it's early, but basically economists think that we're going to see something in the 180s range, which is what they forecast last time, and then we got an upside surprise.
How long has it been a muddle? I mean, we've been in a muddle for a while where people basically are picking their own narrative, and you can get mad at people and say that it's just two things, which is inflation's coming down and unemployment's ticking up. But it feels a bit like a muddle. How long has it been now?
Oh, gosh, about 2 years.
How
coming out of the pandemic, and Tom Barkin had a speech this morning, the Richmond Fed president, asking the question of why did everything go wrong, all the models go wrong. And there's a whole lot of reasons why that they can look back on, but they got it wrong. Everybody got it wrong.
I guess I'm looking at this and I'm saying we're still in a muddle, and yet if you were just going to draw one conclusion from this data that is less predicted than, say, the PCE, which you say is incredibly predictable, you look at personal income outstripping personal spending. And this is an inflection point where you're starting to see that really shift after people used up some of their pandemic savings, at least according to the San Francisco Fed and some data they put out. Is that significant, that personal finances are actually getting better at this point?
Yes, and I'll give you a reason why here. This is a surprising number, and people don't forecast this. Wages and salaries were up 0.7 during the month of May, after 0.2 in April. We know from economic history, to the extent it's valid after the pandemic, people tend to spend what they make. So even though the pandemic savings has gone away, people are feeling, if their paychecks are going up, they're feeling like they can spend money, and that's what they appear to be doing. We don't know if this is the 0.7 rises in general or sort of an outlier because we have seen wages trending down. But in this case, it's a very strong number that would suggest people can keep spending.
Mike McKee, stay close, stick with us. Joining us now to continue this conversation, I'm pleased to say, is Mohamed El-Erian of Queen's College, Cambridge. Mohamed, let's talk about the totality of the data. I'm going to sound like a Fed official. When you look at the totality of the data, are you seeing concrete signs of an economic slowdown, a loss of momentum? And do you think a conversation about reducing interest rates as soon as next month is warranted?
Yes and yes, John. So if you look at the data as a whole, the economy is slowing, and it's slowing faster than most economists expect, and certainly more faster than what the Fed expects. So yes, on the whole, the economy is slowing. And let's remember, this is an economy that has very few buffers. Most of the buffers that we've had in terms of personal savings and in terms of debt capacity, they've been run down. And that leads you to the second question, which is a forward-looking Fed would certainly have the possibility of a July cut on the table.
How much daylight do you think there is between what you think they should do and what they will do?
Too much. If I were them, I would seriously look at July as being a live meeting. I don't think that's the case. I think that's even a question mark in the market. And certainly, if you look at what the narrative of the last few days by Fed official as to whether even September is live. Right now, the market gives less than a 50% probability of a rate cut in September. So that narrative has been pushing back the rate increase towards the end of the year. Had one or two Fed officials would like to keep open the possibility of a hike, and I think that is a long way from where they should be based on what's happening to the economy. But unfortunately, John, they've been burnt a couple of times already. And let's not forget, they're still excessively data dependent. So it takes quite a bit of historic data to get them to change.
So I'm not going to sound like John here. Let's not talk about the totality of the data or a Fed official. Let's cherry pick. Let's talk about some very specific numbers. I want to cherry pick personal income coming in at 0.5% versus the expectation of 0.4%. That is up from 0.3% in the prior month. Mohamed, just looking at personal income and the fact that it's increasing even as personal spending declines, does that give you a sense, if we just wanted to cherry pick that number, understanding the totality of the data is different, that maybe people are actually in a better place and have a greater ammunition and set of financial tools to keep spending at a pretty robust pace?
Lisa, I'd love to be where you are, okay? But there's a problem. Even if we cherry pick, and even if we say 1 month data has a ton of information content, so these are two big assumptions, I wouldn't know if the increased savings that comes from income going more than spending, is it voluntary or is it forced? Are people voluntarily saving more, or do people feel forced to save more? So as much as I would like to go to where you are in terms of that number, I hesitate because first you have to assume away some pretty important things. But secondly, we don't know whether it's voluntary or forced.
That's a fascinating point. I'm sitting here thinking about that at a time when other people might say the reason why they're not spending is because they're not buying homes and they're not feeling like they have the capacity and the mobility to do so. One argument that some of the more inflationistas out there have made is that if the Fed were to cut rates by 25 basis points next month, that would reignite a surge of interest in the housing market, and that you could see actually prices climb much more substantially as a result. Do you believe that to be the case? And if not, why?
So I don't think 25 basis points is going to make that much of a difference to the housing market. That's the first issue. I think you need a lot more than 25 basis points. Don't forget how much we've moved the other way. That's the first point. And second, on housing, it gets even more complicated because supply has been impacted in a way that most people didn't expect. So most people thought that the demand for housing would come down as rates went up. What they didn't realize is that the supply of housing would also come down as people hesitated from going from a very low rate mortgage to a current mortgage. So, again, that market has been distorted by what happened during this long period of rock bottom rates. And we must not forget that a lot of distortions occurred. And in slower moving asset classes like housing, it takes time to get these distortions out of the system.
I'm just wondering if 25 basis points wouldn't necessarily reignite the housing market. Is there still a reverse argument that if they don't cut by 25 basis points next month, that they could be accelerating a tipping point that the U.S. labor market is already reaching?
So that's where I am. I think if you look at the tails of the distribution, or if you look at type 1 error, type 2 error, right now, the one that scares me more is that they are too slow, they are too high for too long, and that economy slows in such an extent that two things happen. First, they can't moderate the slowing, and second, they end up by having to cut rates much more than they would have otherwise, just like they ended up by hiking rates much more than they would have had otherwise because they were so late. So when I look at the tails of the distribution, and remember, I put on the table the notion that a soft landing is 50%, 35% is that we end up in recession because the Fed doesn't react quickly enough, and 15% is the bigger but not hotter, that you get a positive supply shock, something like that. When I look at that distribution, yeah, I do worry. I do worry that the more likely error right now is that the Fed will not start cutting early enough, and then will be forced into cutting aggressively, but it's not going to have the impact in terms of slowing or moderating the slowdown, and then will overshoot on the way down yet again.
Mohamed, there's a new wrinkle. How independent is all of this from policy out of the White House in 2025?
So, John, I've been fascinated by the discussion you've had as to why are markets so calm about U.S. politics. Why are so market calm when the yen is at 160? Why are so markets calm when France, Germany, the spread is at 84 basis points? And the list goes on and on. Why are they so calm when the Middle East conflict can intensify? And I think the reason is because we here in the U.S. have three things going for us. One is a belief in economic exceptionalism, that we can soft land the economy or even no land at all. That's still actually the central scenario for a lot of people. That's number one. Two, that we ultimately believe the Fed will cut. And three, we believe that NVIDIA and the AI revolution is such a positive supply shock that it's going to keep on giving and giving and giving. You know, on the three, I worry most about the economic assumption. And that's why if that economic assumption is tested in the months ahead, then the politics, what's happening around the world, suddenly all these things will capture much more attention in the marketplace than they have so far.
Mohamed, though, we're waking up after a moment where the sitting president had what everyone is calling a disastrous debate. Obama's former campaign manager went on MSNBC and called it DEFCON 1. Alarm bells are ringing. What would be enough between now and November, or potentially what political movement could move the markets between now and November?
So this is your world, and Marie, much more than mine. I think the market truly believes, despite what they hear from some economists, that when push comes to shove, whether it's President Biden re-elected or whether it's President Trump comes back into the White House, the degrees of freedom is not going to be as much. The degree of freedom what there will be, it may be on tariffs, but we've seen that both of them actually are very similar in what they end up doing. So the market, I think, senses that despite what the economists are telling them about fiscal policy, tariffs, everything else, that when push comes to shove, these two individuals, when in power, will be relatively similar in economic policies. Why? Because we've had 4 years of each, and the market has been able to observe what they've done. Now, bring in the possibility of someone new, and that suddenly changes that whole construct. So responding to your question, that's the big question, is that if you bring someone new into the equation, how will the market evaluate and what degree of confidence will markets have? It really helps the market that they saw both individuals in the White House.
Mohamed, I just want to finish on this and get you to elaborate on a finer detail. In the UK, the gilt market has been a constraining, regulating force on all kinds of policies coming out of either party in this election race. And you can see that in the nervousness they have talking about the deficit. You're seeing a similar thing take place in France right now. Do you think this Treasury market could become a regulating force over the next administration in this country, in the United States? Or will we retain that unique privilege to do other things?
We will retain that unique privilege, John, because the rest of the world is so messy. So I think of it very simply. Whether it's France, whether it's the UK, they solve an absolute space. If there is fiscal irresponsibility, then they will feel it regardless of what's happening elsewhere. The US bond market solves in relative space. So as long as other countries are more irresponsible than us, then we can continue being irresponsible.
Mohamed, you're one of the best. You're going to stick with us. We want some final thoughts before we go into next week. Mohamed El-Erian there. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of that data we got about 15 minutes ago. It's the Fed's preferred inflation gauge, and it came in line with forecast. Core PCE deflator rose at 0.1% month over month, and that's the smallest advance in 6 months. Personal income in May rose 0.5%. That is higher than estimates, while personal spending was just a touch softer than estimated. The data likely will boost the case for cuts later this year. A check on Nike shares tumbling in the pre-market, down 15.33%. Its full-year outlook fell short of expectations. The company said that revenue would decline in the mid-single digits this fiscal year. Nike has been struggling to churn out lifestyle wear with little offerings to replace prior top sellers like Air Force Ones and Dunks. Instead, rivals have picked up the slack, like Adidas, who says retro Samba sneakers are fueling a new era of growth. The NFL is facing a massive antitrust lawsuit after juries sided with fans over pricey broadcast subscription costs. The league was hit with a $4.7 billion worth of damages, which stands to be tripled to $14 billion under federal law. Fans had claimed that the league conspired with DirecTV to raise the prices to watch out-of-market games. The league made the unusual decision, though, to take that suit to trial. Commissioner Roger Goodell appeared as a witness in it. A league spokesperson called the verdict disappointing and said the NFL Stifel plans to appeal. And that's your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Have a nice weekend. Up next on the programme, we'll set you up for the week ahead. You're watching Bloomberg Surveillance. Mohamed said it's dressed down Friday, so I guess it's dressed down Friday. Equity futures positive by 0.2% on the S&P 500, counting you down to the opening bell. Here's your trading diary at 10 a.m. We'll get the UMich sentiment survey, followed by more Fed speak from Bauman and Daly at noon Eastern. On Sunday, it's the first round of French elections. Monday, ISM manufacturing numbers. Tuesday, JOLTS data. Plus, Fed Chair Jay Powell speaking from the ECB forum in Sintra, Portugal. Wednesday, another round of jobless claims into Thursday. US markets, of course, closed for the 4th of July holiday. Plus, the UK holding its first national election in 5 years. And finally, if you get through all of that, you've got the payrolls report on Friday. For a final word, joining us now, Apollo's Torsten Slok together with Mohamed El-Erian. Fantastic to have the two of you with us. Mohamed's really laid out a different kind of story, Torsten, to the one that you've been pushing over the last couple of weeks. Let me just begin with what you thought of what Mohamed had to say in the last 15 minutes.
Well, I mean, as we talk about every day, I mean, there's a lot of things going on in different data points. But I do think that the incoming data, in particular the more important data, it still shows the economy doing well. Non-farm payrolls at 272,000 was good. Now the consensus expects 185 for next Friday. That's not bad either. We have the Atlanta Fed GDP now expecting GDP growth in the second quarter of 2.7. That's not bad either. Jobless claims are moving exactly in line with the seasonal patterns that we normally see. And finally, if you look even at that weekly Red Book same-store retail sales, it's also chugging along very nicely, together with car sales, which should have been down, but it's also still doing very nicely. So it's a little bit difficult at this point to see, and I think Mohamed agrees with this, we're not seeing the economy fall apart. It is just the case that a lot of the incoming data just still continues to point to an economy that has two tailwinds from easy fiscal conditions, meaning we still have support from the CHIPS Act, the Inflation Act, and Infrastructure Act, and we also still have easy financial conditions providing a tailwind. So overall, we still see steady growth for the next several quarters.
So I can't handle all of the people who are so casual, everyone laying their hair down on this Friday. Before we get back to you, Mohamed, let's get to you, Torsten, on the point that Mohamed was making, that the balance of risks right now is more seriously tilted to the Fed making an error by not cutting quickly enough because of weakness that you're seeing in the labor market and because of a real concern that you're seeing among the average household.
Yeah, so there's certainly some distributional issues. Those who owe money, meaning those who have a lot of leverage in the household sector, those who have a lot of debt, they generally have been hit harder by interest rates going up. That generally tends to be lower income households. Higher income households have, on the other hand, been benefiting from stock prices going up, home prices going up. The cash flow from fixed income has not been better in decades than it is at the moment. That's why in the Fed distributional accounts, for the 80 to 99 percentile of the income distribution, you're actually beginning to see cash balances go up in the last several quarters. So high-income households are still providing quite a nice tailwind overall to consumer spending. But you're right, Lisa, there are some distributional aspects. But overall, when you look at the outlook for consumer spending, including the data we just got this morning, income is still very strong. And you also have on top of that, low unemployment rate at 4%. It's just that's very difficult to see that slowdown that the Fed is anticipating.
Mohamed, what would you tell someone like Torsten Slok, who thinks that right now the Fed is not going to cut rates, that there still is enough momentum to keep this economy going?
So I think the Fed is not going to cut rates till it's too late. Just to be clear, I think it should be cutting rates earlier, but I don't think it will. Look, I think that there are fundamental differences in the following areas. One, is it distributional weakening, the K economy, or is it general weakening? That's issue number one. Issue number two is, are the forward-looking indicators telling you the same thing as the backward-looking indicators? And the answer is no. The forward-looking indicators are weakening, whereas the backward-looking indicators are still relatively strong. Not as strong as they were, but relatively strong. And then third, something that you've heard me say over and over again, that I wish macroeconomists would do more often, listen to the company's earnings call. Listen to them. Walgreens. I mean, I can go through the whole list. They're all seeing weakness. They're all responding to weakness that they're seeing in the pipeline. So I understand the data is ambiguous, but I think that ambiguity goes away if A, you distinguish between forward-looking and backward-looking, and B, you inform yourself by what sort of the bottom-up is telling you, as well as the top-down.
Mohamed, do you know the excuse we're hearing about Walgreens is that it's idiosyncratic? They're dealing with problems around theft. The store experience isn't what it used to be years ago. What would you say to the people using that word repeatedly, idiosyncratic, on a range of companies at the moment?
I say you're using it too much. You're using it on a range of companies. You just answered the question. They're using it so often that you ask the question. John, I remember this in 2021 when the companies were telling us there are price pressures. We feel confident passing them on to the consumers. We're going to be raising prices. And you would hear, oh, it's isolated. Okay. And people didn't listen. And by the time that played out in the macro numbers, it caught most people off guard. I'm just saying these are tails, John. It's really important to remember you're talking about the tails of the distribution, and you're talking about how is the balance in the tails of the distribution.
Torsten, how would you explain the distinction between what you see in the survey data, the soft data, and what you see in the hard data right now?
Well, I do think, I mean, as Mohamed is saying, on the earnings side, it has certainly been the case that some companies have been warning more to the downside. There's also several companies, airlines, hotels, restaurants, sporting events, concerts, where you're still seeing relatively strong business. Even Broadway shows is still the weekly data showing quite significant strength. So I think that what's really important in this discussion is that the Fed, they have, in my view, actually moved a little bit away from being data dependent to really more being star dependent. That there is this incredible desire to lower interest rates, the sooner the better, even though the incoming data is actually still quite strong. How can you start talking about lowering interest rates when non-farm payrolls is 272,000 and the unemployment rate is only at 4%? I know it's gone up a bit, but all this still suggests that is there really a reason to start talking about cutting rates soon when the incoming data actually and the data dependency now is less relevant when the data is actually still coming in quite good?
At least we can all agree on one thing. It's no tie Friday. Torsten Slok, Mohamed El-Erian to the both of you.
John, put your Jets tie back on, please.
I'll hold it up in the air for you, Mohamed. I'll put it on later when I leave the office, all right? Just for you. Bit of Jets to go into the weekend. Mohamed, Torsten, thank you. Coming up on Monday, Marvin Lowe of State Street, JP Morgan's David Kelly, Cameron Dawson of New Edge, Steve Rasciuto of Mizuho. You all have a wonderful weekend.
You too. You look so relaxed. Who is this person?
I'm so chill. Everyone knows. I'm like the most chill guy in New York.
You were just exuding chill.
So chill.
Oh my goodness.
So relaxed. Not intense at all. No. What are you laughing for? What's funny about that?
I like this no tie, John.
There you go. Good.